Green and JSPL. Multiple dealing rooms are suggesting positional buy calls when it comes to GAIL and Adani Green, and sell call on JSPL. Now these positional calls are given based on technical levels, so that's keep an eye out for all these three stocks. Indigo is the other stock that remains in focus. Now dealers indicate that there is a buzz of a potential block deal that could come in from the Gangwal group post the company reports its numbers. They will be reporting its numbers tomorrow, so keep an eye out for Indigo as well. Gangwal group owns close to 13.5% stake in the company. Inox Wind. Now large HNIs have been seen accumulating this counter on expectations of strong Q4 numbers. The company is yet to come out with the date for Q4 numbers, but keep an eye out for Inox Wind as well in trade. And lastly, it's IGL and MGL. Now both these city gas distribution stocks are down in trade. Dealers are indicating that there's a potential buzz of a cut in city gas the gas allocation for the city gas distribution companies. Now current allocation is anywhere between 37 to 39%, and this could come down to 33% is what dealers are indicating, and that's one of the major reasons why MGL and IGL both are down in trade.
Samit, you track Interglobe quite closely. I want quick follow-up on that one. Is this a concern at all in your opinion, and how do you believe the street will react if this were to actually go through?
Well, this overhang, it's more of an overhang, and it has been going on for a while. Time and again, when the lockup period ends for Gangwal, he goes ahead and sells some stake, and we all know that he wants to completely exit from the company. He owns 13.5%. Most likely, he'll come out with a 5% block this time. So most likely, a couple of more blocks, and then he'll be completely out of the company. But fundamentally, nothing seems to be wrong for Indigo. Just an overhang that is there for the company because of this block deal that is happening from one of the promoters.
So more positive than negative.
Right.
Okay. Thank you so much, Samit, for that. Yes, he does have a very good hit rate. So you'll want to watch out for all of those stocks. I want to quickly ask Dharmesh. Dharmesh, how do you view Interglobe at this point? Of course, and Dharmesh Kant joining us. Apologies. Need to introduce Dharmesh Kant, Head Equity Research, Chola Securities, also joining us this afternoon. Dharmesh, let me come straight to you with regard to Interglobe. What's your view with regard to an Interglobe Aviation?
Yeah, Gautam, it's a constructive view. I mean, only two players are majorly left in the Indian aviation space, and with the crude prices being where they are, and it's likely to be, benign going forward. Maybe $60 to $70 a barrel on the Brent crude is likely to be the range going forward. And internationally, even demand is not rising. So that's the biggest, plus point for any aviation company which is operating in the country. And aviation itself is going for a very rapid expansion, be it airports or destinations, and the number of flyers is growing by 12 to 15% on an annualized basis. Interglobe Aviation is doing a strong capex. So going forward, I mean, because of depreciation impact, the operating profit or the EBITDA may not. I mean, EBITDA may be still be good, but the PBT level you may have a difference in the growth rate. But structurally, if one is a buyer for, I mean, this has become a wealth creator now for if you are holding it for 3 to 5 years kind of a perspective. So the advice is any such, news flow kind of a decline which is there is a good opportunity to buy the company.
Okay. Kush, your view?
Well, I think this is a good consolidation phase, for something like an Indigo. The moves have been rather sharp. It's in a rising upward channel. Just now, it's faced at resistance around the 5,600 mark and slipped to slightly lower end of the band, not close, but slightly closer to that. 1,500, 5,300, I beg your pardon, is where that support zone comes in. So I will take this dip as long as that upward sloping channel, the support zone is intact. As I said, it comes to the 5,300 mark. Around those levels, this might just turn out to be a buying opportunity. On the whole, the medium-term, long-term strength in the stock is visible. That trend is very much intact. So as long as 5,300 is held, I think this will be a good buying opportunity for anyone who missed out on the Indigo rally, a couple of months ago.
Okay, so no confluence of fundamental and technical, at least on this one. But I want to quickly understand from you what you make of the index move, Kush, because we've slipped about 100 odd points in the last hour or so. So clearly there's pressure. What does this do in terms of taking a trade on the index? What's your view?
Harsh, what has also happened is that the call writing levels, have shifted lower. 25,000, as we spoke at the start of the show, was the pivotal range. But from there on, what's happened is that 24,900 and now 24,800, these are the levels which are seeing some fall writing. What this also suggests is that possibly we might not have a V-shaped recovery in the coming days, but 24,700 was the level that we were talking about anyway, and precisely why about 40 minutes ago at the start of the show, we did not initiate a buy call because there wasn't really any kind of rebound coming in on the Nifty. So I will wait for a day or so more. 24,700 could still well be, that support zone that we've been talking about, and the market could hold ground around those levels. So I will wait and watch. Let the day pass. See, if any kind of rebound does come about tomorrow. So for me, this is the support zone. Nifty should hold its ground here. If it does not, then you're looking at 24,400, which is the 20-day moving average. But that I would say is some distance away. So hold your ground. 24,700 if held, we could see some sort of a rebound to back to 24,800, 24,850 levels in the coming days, perhaps tomorrow day after.
Hold your ground at this point. Dharmesh, your quick take with regard to how you're reading into markets. We've seen a bit of a rally. We're starting to see a bit of consolidation now from fundamental perspective. Are there some pockets which are interesting you at this point? Are you waiting and watching? What are you advising?
Yeah, definitely. I mean, from the correction point of view, today has been a sharp correction. I mean, the stocks which have rallied 6-7%, today is down almost 3.5%. So such kind of a correction is definitely, unsettling. When you, I mean, 1.5 to 2% correction is okay, but if you see 3-4% kind of a fall on the counters which are showing strength, does merit a caution. Having said that, I think, again, this is a good opportunity if you missed the initial part of the rally to get into the bus, because the macros are playing in favor of country, be it inflation rate, be it interest rate, be it monsoons, tax benefit, and now this tariff saga is settling down. Putting all these things into light, I think one space which looks pretty attractive to me, given the upcoming of the monsoon and the wedding season, is the two-wheeler space. Both Bajaj Auto and Hero MotoCorp, which has seen a good correction today, are good candidates to get into. That is one space which we are liking very much. Apart from that, public sector banking space. I mean, these two are clear winners to my mind in next leg of the upcycle. So this is the space where one should be investing into in today's form. Only one advice: don't go all in. Get it a structured, I mean, one third kind of a step down kind of approach while you are investing in this market.
If Dharmesh, if you were to put 1/3 at this point, how long would you wait for to deploy the next 1/3 bucket of your portfolio?
So 1/3 I would deploy today itself in this fall which we are seeing. I mean, Kush is suggesting, 200 points more from here can go on Nifty, but that's okay. And next leg of decline, I'll wait till first week of June. I mean, I'll wait for this news flow on the India-US tariff thing gets settled. And by that time, RBI policy would also be around the corner. So the idea is very clear, Harsh. If I buy 2% or 3% up, I am happy buying a stock on a upswing rather than on a downswing, because if it's an upswing, it gives you a clear indication that waters have settled and now the trajectory is clear up, because fundamentally these companies are good. Both Hero and Bajaj, I think the numbers would be 7 to 8% kind of a volume growth going forward in the month of May and June itself, which is better than 3 or 4% kind of a growth which they were witnessing in domestic markets. That's one factor. And public sector banks, as I've said, the numbers has been excellent for all 4 quarters and for the year. And with more leeway coming in the form of, say, lower interest rate and higher disposable income, they would reap the benefits of credit growth faster than the private sector peers, because the capital adequacy ratio is far in favor of them, along with the CD ratio. Valuation wise, still they are very comfortable. So to name a few, like Bank of India, smaller like UCO Bank, Union Bank, Bank of Maharashtra, they look pretty attractive to me on valuation metrics.
Okay, so that's the view coming in. Thank you for those views, Dharmesh. Stay with us because we're going to quickly jump to the stock of the day, which has jumped 11% today. So Pfizer is the stock of the day, and the company posted very strong performance for the March quarter. Varsha joins us with how the performance was and how she evaluates it. Varsha.
Yeah, thank you for that. So overall, good set of numbers. But if you see, the highlighting factor here was the EBITDA and EBITDA margin, because if you see, the revenue growth was only 8% for the company, but EBITDA was up 20% and margin were 38% versus 35% last year. Now lower other expenses have actually aided EBITDA and EBITDA margin, and the net profit, if you see, net profit is up almost 85% for the company. But here's the catch, net profit impact was led by higher other income and lower tax. Now what is this higher other income? The company agreed to sell its Thane land lease at and the buildings on it, of course, which originally belonged to Pfizer, but they plan to sell it to Zoetis Pharmaceutical Private Limited, and the sale price was almost 264 crore, and company had already received almost 52 crore in advance, but the remaining portion of around 170 to 180 crore is the other income that the company has has been focusing on, or that's the other income lying in the profit and loss, and that's the reason you're seeing huge impact in the net profit. A lower interest cost also aided net profit for the company. Now there was this news in the morning with US Pfizer and Chinese biopharmaceutical deal. Will that have an impact on Indian Pfizer company? The answer is no. Why? Because if you see the export in FY24, the export stands at around mere 4% for the company, and there was no related party transaction with Pfizer US. So no impact when it comes to the agreement between Pfizer in the US and the Chinese biopharma company, because since this is a licensing agreement, Pfizer US will be selling this product in China only. But because the name is attached Pfizer, that's the reason, maybe because of all the sentiment, maybe one of the reasons why Pfizer has Pfizer is buzzing. But the other reason is strong Q4 numbers and strong portfolio when it comes to the oncology products for the company, and of course the neurological products.
Okay, so that's Pfizer for you, Dharmesh. Thank you so much for that, Varsha. Dharmesh, coming to you quickly with regard to a Pfizer, how do you view it, and how do you view the broader sector, because you're starting to see pharma numbers come through? So what's the sense like in terms of numbers? What themes are you liking? What's your key takeaway?
So the numbers have been pretty there on the line. I mean, Pfizer, if you look at the numbers, were excellent. And as you pointed out, that 3% kind of an operating margin, plus was mainly because of a better product mix on oncology and neurology. So those are high priced products anyways. But if you look at the entire MNC pharma space, so there's an Indian pharmaceutical companies and then MNC. So there the other factor which is playing out for Pfizer is the better growth numbers and the relative comparatively low valuation multiples. So if you compare this with say a Sanofi or AstraZeneca, it's far cheaper to that, even for that matter GlaxoSmithKline. So it's trading around 10 to 15% discount to that even. Having seen all this in light, and US tariff saga on pharmaceutical being played out separately, so my sense is all these MNC pharma companies will be benefited, because anyways this tariff is about to come. It will definitely come, maybe 5%, 3% or whatever is the impact, but it will be there, and these companies can get protected because of their parentage being outside India. So that's one thing which is playing out. It's a momentum trade. Other than that, for India pharmaceutical companies, say for example, Aurobindo Pharma or a Sun or a Cipla, would like to wait and stay out for some time till the clarity emerges on the entire, phasing of this tariff on the pharmaceutical products.
Okay, and what about you, Kush?
Well, I think at the moment this is a book profit kind of a scenario on Pfizer. I mean, there are more than a couple of factors pointing out that there could be some resistance. Dharmesh said, this momentum trade has been building up for some time, but a very strong up move today. Now resisting at the 200-day moving average. So that's the first one. 50% retracement resistance also acting upon it. It's already overshot in the overheated territories on the RSI parameters. As I said, a few more factors going for it. So all in all, I would suggest if you have a position, it's not a bad idea to book some profits and take some money home. If you are looking for an entry point, then I think a rather decent one comes in close to the 4,800 mark, where you've got some support zone, and the stock could once again rebound and rally higher from there. But for now, you could consider booking profit partially, if not fully. So Pfizer, no initiation at the moment, and if you have a position, at least consider booking partially.
Okay, so that's the view coming in with regard to Pfizer. both on fundamentals and technicals. Let's go across to another one in focus, Eternal, which is Zomato. Shareholders have approved a cap of 49.5% on foreign ownership, meaning foreign institutional investors cannot own more than this percentage in the company. Stock under pressure on the back of that. Mahima joins us with a better perspective with regard to that. Mahima.
Right, so as you rightly mentioned, shareholders have now approved the fact that board did approve earlier that 49.5% is the cap to FI holding in Zomato. The board of directors had already approved that, and now shareholders have come out and given the approval on the same. Now, in terms of how this impacts overall, in terms of how funds will flow out of Zomato, plus how it will change in terms of the way Eternal will work. Firstly, it will trigger the MSCI and FTSE passive selling. Selling could be as much as $1.4 billion in multiple quarters. In terms of MSCI details, current weightage is around 1.3 times. This will become half, and outflow will be anywhere around $600 million to $800 million. For FTSE, the current weightage is around 1.17. The outflow could be anywhere between $500 million to $600 million after review. And first review will happen in June 2025. After that, every quarter will see outflow of around $70 to $100 million. In terms of what this means for Eternal, last QIP where Eternal raised around 85 billion, there was an increase in terms of domestic ownership which was seen. 8% overall was subscribed by domestic funds. Post the QIP, FI ownership fell to around 47%. DI ownership increased to around 20%, and currently DI ownership stands at around 23%, and FI ownership continues to fall, and now it is at 44%. Increased domestic ownership aids basically your data localization norms, your control over inventory, as well as safeguarding local consumer data. Plus, inventory based model will be adopted by Eternal going forward, and better control over product quality and pricing will take place. Higher margins through bulk procurement could be one of the factors that could work positively in favor of the company, and easier promotion of private label could also take place. But challenges, of course, this comes with a lot of challenges, including requiring of stronger grip over operations, plus requires high working capital, and plus there could be risk of unsold and obsolete inventory as well. So this is the overall view as to how and what this means for Eternal exactly.
Okay, so that's with regard to an Eternal stock under pressure on the back of that. Dharmesh, how would you view a Zomato Eternal at this point? There's of course some bit of pressure on the business side of things when you're looking at quick commerce and how the competition is evolving there, how margin pressure is coming through. But on the other hand, food delivery doing okay and adding in terms of the way that performance adding up and aiding the cash burn which is currently happening in quick commerce. So how should you view the business, and how do you view valuations at this point? Far cry from the 40 rupees that we saw at the bottom, but of course it's fallen quite a bit from the top as well.
Yes, valuations is anybody's guess. I think this is more of a concept buying on a business front, and actually to arrive at the valuation multiple, I think we are still 5 years before. I mean, it will take more 5 years for this business to evolve, and then the methodical yardstick of valuations can play out. As of now, it's more of a market share gain, and the part to profitability, like operating profit and all, how it is, at least they should be in the black. My own sense is that there will be consolidation in this entire space, quick commerce and delivery, food delivery. And the entire, e-commerce space will come in for, as far as the delivery segment is concerned, will come in for consolidation. And going forward, maybe 2 years, 3 years down the line, it will be left to 2 or 3 major players. And there, to my mind, Eternal has always been ahead of the curve because it's more of a promoter-driven kind of a company, and it's always came out with new ideas and others are following up, except the quick commerce part where Swiggy, first launched it. But apart from that, they have been doing pretty well. Cash burn, if you look at it, I mean, Eternal is one of the few companies which is now not burning cash that faster as others are in trying to grab the market. So there also, I think they are better off. One has to be in this space if you are an investor and a long-term investor. Definitely, this space does merit our attention. And there, I think I would pick only one stock, and that would be Eternal to be invested into as as of now. Maybe as situations evolve and delivery and everything other also gains larger, pan-India presence, then one can look at that. I mean, Amazon is also into the fray. We don't know when it will come into the market place, but definitely it's also down the line. As of now, in this correction or corrections going forward, should be an opportunity for investors to take a long call rather than traders or somebody like that, because volatility is likely to stay here.
And what about your take, Kush, with regard to technicals on this one?
I mean, it's spending what looks like an eternity, in that 200 to about 240 band. If I were to speak in technical terms, in the 23% and the 38% retracement, it's spending a lot of time there. But I think this is a healthy consolidation. This is a healthy time and price consolidation, as you rightly said. From all the way from those 40, 45 odd levels up until about 300, where it went in about 17, 18 months kind of time span. So I think this is a healthy move. I think for me also this is a good accumulation zone. As long as the 200, 198 kind of levels are intact, I think this should be a good buying opportunity. Momentum is missing, supply pressure at the 240 mark, so that is something that you have to keep in mind. But if you're looking at it from a 6 to 12 month kind of a horizon, maybe longer, then this is a good time to buy and hold something like an Eternal.
And the other one also in focus is a DOMS Industries. Stock has plunged. Tough set of numbers which came out yesterday. It didn't look good at the face of it. Mahima is again still with us to give us an understanding of those numbers. Mahima, what do you make of this one?
Right, so in terms of DOMS, I think what the street is not liking is the kind of margin downtick that it has seen this quarter. Plus, export shares has also gone down. In terms of the overall numbers, revenue was up 26 odd percent, EBITDA up 16%, margins came at 17.4 versus that of 18.8. Net profit was up 7%, which has been a double-digit growth otherwise in previous quarters. So I think that is something also that the street is not liked. Now, in terms of what has impacted margins as well as profitability, employee benefits expenses has gone up by 28 odd percent. Other expenses has significantly seen a gain of about 37 odd percent, and depreciation has also gone up by 42%. This is because of the capex plan that is ongoing for the counter. Now, in terms of capacity expansion, the company has said that it's underway of a 44-acre land parcel in Gujarat, and the possession of first building for installation of plant and machinery will happen by the end of Q3 FY26, and they expect commercial production at the first building by the end of Q4 FY26. So I think it's the margin downtick and a single-digit growth in terms of profit that the street is not liking for something like a DOMS, and that is why the stock is under pressure today.
Okay, so that's on DOMS. Dharmesh, not sure if you have coverage on this one, but from whatever my interactions have been, very strong growth guidance, but not meeting that. In fact, margins coming under pressure, not looking good.
Yeah, we did had an IPO note on this. See, the problem is such kind of a company which is more of a product company, and if you are commanding a valuation of say 70, 80 times P multiple, so there the scope of error is not there. And if you are unable to meet your guidance, then definitely this kind of a punishment market gives you. I don't think the numbers were that bad, but seeing it in the light of the aggressiveness with which the management was giving the guidance, and now and the valuation multiples which it was commanding, so definitely, I mean, there are many people who have got it at an earlier trajectory and pre-IPO kind of a thing. So those sellings are likely to come. And the only advice to investors is, if you are buying a product company, that to a stationary kind of a product company, which anyways is, with advent of technology, knowledge coming down rapidly, if it's trading about 70, 80 times kind of a P multiple, please be very mindful before investing.
Okay. Interesting take coming in with regard to DOMS. Kush, of course, very limited chart on DOMS, but would you at all have a view, or maybe I can ask you something else?
No, a near-term view for sure. So I think a good support zone is at the 2440 mark. That's a medium-term support zone for DOMS. So if that is taken out, then I think the stock could see further downside of 2300 levels anyway. this 29,53,000 mark was proving to be a very, very stiff resistance where it was not able to successfully cross for the last 7-8 months, maybe a little longer as well. So all in all, pressures were evident. It is starting to play out now. 2440 is the level to watch on the down.
And Kush, I'm also curious to have your view with regard to some of the defense counters. The defense counters in the private space seem to be under some bit of pressure today. Of course, then you have a Cochin shipyard which is down 8%. What's the view with regard to that pocket? Because it's done ever so well last week and now you're starting to see cracks. What should an investor do or a trader do at this point?
So, Harsh, if your viewers did indeed heed to our advice as to whatever we've discussed over the last couple of days on the defense names, I think they'll perhaps be smiling even in the face of these cuts. The reason being, what we suggested was hold 50% and book out 50%. The reason being that these stocks are now again seeing that surge that they had seen up until the consolidation began 12 months ago. You wouldn't want to be completely out of these sectors. So my suggestion was to book 50% of your holdings and then re-enter at slightly lower levels. So the likes of Paris Defense and Idea Force, they're now starting to see what can at best be called a profit booking. So wait for some more time, let this dust settle. These are the stocks that you'll perhaps get a re-entry into once again. In any case, if you're holding at 50%, it's not too much of a FOMO or a fear of missing out kind of a factor anyway. So right now, if you put 50%, hold, let them find their feet again. And these are the stocks that you'd want to re-enter once they hit those support levels.
Okay, gentlemen, thank you so much. We'll let you go on that note. Thanks so much for joining us, giving us all of those views. What we're also going to do, viewers, is slip into a very short break. On the other side, we're going to get you top BTST picks. And along with that, we'll have a fresh set of guests, Neerav Ashar, Aditya Agarwala, giving us their views, and a bull versus bear on HAL. Stay tuned. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers. You have the numbers of Solar Industries flashing at the bottom of your screen. Looks like a strong set, 37% profit growth. Despite that, stock under pressure, but that's because the larger defense theme is under pressure. And we saw a downgrade coming through from a UBS on HAL, and therefore thought that it's good to do a bull versus bear on it. Anushi, standing by for a bull versus bear on HAL.
Right, Harsh. So in what we've seen for Nifty India Defence so far, last week, strong rally, about 19% of gains, but we've started seeing some bit of profit booking in terms of where these defense companies are. HAL particularly in focus. This is after it came out with its conference call on Friday that we've seen, and after that, there's been a lot of discussion in terms of where the guidance is and if the guidance is going to support the kind of valuations that the company has. So we have two notes coming. Firstly, in the bull scenario, Jefferies, they've maintained a buy on the stock but hike the target price to 6,475, looking at a big upside here for HAL from Jefferies. While on the other side, UBS has downgraded the stock to neutral rating. It's the first downgrade that we're looking for HAL over here, and this is with a target price of 5,600. So despite the downgrade, we are looking at a reasonable upside coming for UBS as well. Just some of the key highlights that we are looking at as to why Jefferies has remained bullish, but UBS has remained neutral on the stock. Firstly, margin front, 30 to 31% is the projection that they expect to continue in the upcoming years as well. Now, we did see about 30% of odds or margins in FY25. They expect this to sustain given the cost optimization practices that the company is seeing for the company. So clearly on the EBITDA margin side, it is a strong point that we are looking at. Along with that, it's also the high margin service income and aircraft deliveries which should drive this double-digit revenue growth for the company for the next 3 to 5 years. Along with that, if we look at the India-Pakistan tensions also, they've happened. It has increased focus towards these defense manufacturing companies. So that is something that has increased the confidence as well. Whereas UBS has said that despite all the positives that we are seeing, most of the positives have already been priced in. That's why that's now downgrading the stock to a neutral rating. They've also cut their order book CAGR growth of 21% to 14% post the recent management guidance, which is there in terms of 8 to 10% of a growth. So that brings us to our second point. So if you look at the order book now, while that is up over 95% this year at 1.84 lakh crore in FY25 with a huge pipeline of opportunity of over 2 lakh crore as well, it's the guidance in particular wherein the street is not overjoyed by this 8 to 10% of a revenue growth guidance that we are looking at, because considering almost the huge book-to-bill ratio that the company has in terms of execution, in terms of revenue growth, this seems more on a conservative side of a 10% of a revenue growth guidance forward for the business. So that is something that we should be watching out for. But if you are talking about another aspect as to the bull and bear case scenario, if you are seeing now clearly the stock, if you are seeing the biggest cheer point for it was the overhang which was lifted was the GE Aero delivery of 404 engine, which is expected to start this year. Now this was the expectation. The expectation is also about delivery of 12 engines by this year and itself. So that would expedite the kind of growth visibility forward for the business. However, there are the two other orders which were expected for FY28 have been pushed beyond FY28 with the expectation now that these will come through FY30 as well. This includes major platform orders including the LCA Mark II, light combat aircraft Mark II, along with Sukhoi MKI upgrade that we are seeing at. So in terms of where the order book picture could play out for this is something that we should be watching out for, which brings us to our final point, which is the most important one in terms of the valuations. Now, if you are looking at 1 year forward PE of 39 times with the kind of 8 to 10% of a revenue growth that we are seeing, are valuations justifiable? That's the biggest point that we should be watching out with the company. Again, execution will remain as a key monitorable, because any supply side issues now impacting the company would directly have an impact on the visibility going forward. The stock is almost up 60% as well if you see the last 3 months. So that is something that we should be pricing in for the company. Valuation remains a key concern. On the bull case scenario, it's quite clear that increased confidence that we are seeing is also, especially after the Indo-Pak tensions that we are looking at, there has been higher focus on defense companies to expedite their manufacturing going forward. So that is the bull side that we are looking at. But overall, that's the overall picture that we are seeing for Hindustan Aeronautics. On one side, while the growth prospects remain on the healthier, it's on the bear case scenario. It's the major concern is whether the revenue growth which we are seeing, are they enough to sustain the kind of valuation that Hindustan Aeronautics command? Back to you, Harsh.
Okay, so very interesting. HAL and the entire defense pack, to be honest. Let's look at, let's go across to our guest. Neerav Ashar, Head Equity Research at Latin Manharlal Securities, joining us. And we have Aditya Agarwala, Head of Research and Investments at Invest for EDU. Let me come to you first, Neerav. Neerav, with regard to defense, we've seen a huge rally. The questions now seem to revolve more around valuation comfort and not with regard to potential. Do you feel that those arguments are justified?
Well, good afternoon and thank you for the invite. Yes, actually, the defense companies have gone through a roller coaster ride. It's been a very volatile phase for the defense companies. We had a time where the defense companies were the darlings of the market, and then of course there was some disappointment with respect to the execution. And then, of course, we had this surprise in the form of Operation Sindoor, where the world could see it was a demonstration of the capabilities of the Indian air defense systems, missile systems, etc. So I think it's been a kind of a game changer. This event has been a game changer, and we've seen the valuations prop up again. And again, the same question which arises with respect to the valuations at this point of time. So it's very important to bear in mind that there is a lot of lumpiness with respect to these defense projects. There is a lot of focus on indigenization. There is a lot of rigorous testing which the defense equipments tend to go through. They are subjected to a lot of rigorous testing in different conditions in which the defense equipment is used. So I think having come out of all that, having successfully passed all these exams, and we have seen the practical implementation of the same. So I think the prospects remain quite strong. We've seen India's defense exports more than triple over the last 5 years. We have an ambitious target of doubling our exports in the next 4 years, and the domestic order book is quite strong. But having said that, I think with the revenue guidance coming in so conservative, especially with respect to Hindustan Aeronautics, which we just spoke about, I think it definitely warrants some amount of caution. We need to see how the execution actually takes place quarter-on-quarter basis, and need to ensure that there is some amount of consistency in the deliverables going forward. To conclude, I think the valuations are no longer cheap. They are trading at more than 40-45 times at this point of time. So definitely we've got to wait for a correction to see more attractive levels before we make an entry into these stocks.
Got it. What kind of a correction will you wait for, Nirav, before this looks interesting?
I think at least 15 to 20%.
15 to 20%. Okay, so wait and watch. Aditya Agarwala, the Nifty defense, while the launch date was in April 2022, the base date for it was April 2018. In 7 years, it's been 8x. From a technical standpoint, how does this look from a chart perspective? And any names that you have, whether you have a buy call, sell call, any strong calls that you have within defense?
Hi, Harsh. Good afternoon. Thanks for having me on the show. I think the worst is over as far as the defense is concerned. We had about a year and a half of consolidation as far as this entire Nifty defense sector is concerned. Yes, it has seen a sharp up move following the escalation of war-like situation between India and Pakistan, and basically there was a switch from one sector to the other, and defense being the prime focus, everybody did look at defense as the best sector to look at during that point of time. And all that we are witnessing right now is a bit of a profit taking. While these companies do hold some challenges and some fundamental tailwinds, I think if you purely go by the chart setup, a lot of these stocks do look attractive to me, especially if you're looking to build a portfolio from a longer term time frame. To give you a few names, I think BEL, BDL, HAL, these three stocks do stand out for me. And any point of correction in these stocks, maybe a 4 to 5% correction in either of these stocks, be it an HAL or a BDL or a BEL, you should look at start buying into these names, because if you give it a year or so, I think all these stocks are going to see much higher levels, and the kind of buoyancy that we had seen in these stocks following the tensions between India and Pakistan, that is not likely to go down so soon. I think there is more room on the upside. At least 20 to 30% is what I see in these stocks. In any event of correction that you're witnessing now in these stocks, it's an opportunity to go long and hold these stocks. So the top three names for me are BDL, BEL, and HAL in defense space, followed by a Mazgaon Dock.
Okay, so those are names which look good to Aditya from a technical perspective. Aditya, your quick calls as well for the day, because we haven't had a chance to take those.
Right, Harsh. So given the fact that markets become little choppy and volatile, I've got a buy and a sell. I'm keeping a very close eye on the Nifty VIX that has actually turned upward from that support level of 16. And I'm keeping a close eye on that 18 level, though it hasn't breached that 18 and markets have seen a bit of a correction. But 18 is the mark that I'm closely eyeing for, and not for today, basically for tomorrow. If 18 level is breached on the upside as far as VIX is concerned, then you could be in for a sharper correction. Coming to stock specific ideas, like I mentioned, keeping this in mind, I've got a buy and a sell. Bajaj Auto for me is a buying opportunity after a sharp run up in the stock today. It's a bit soft in trade. It's providing you an opportunity to go fresh long at current levels. So for a target of 9,300, I'll use this opportunity of correction in trade today to go long with a stop loss at 82.20 on the downside. The second stock is a sell, Muthoot Finance. The entire structure of this stock has been butchered now, and it's looking like it's headed further lower. For a sell call, I will go short on this stock in the future segment. Look for a target of 1900 on the downside with a stop loss at 2100 on the upside.
Okay, so those are picks coming through thick and fast. Let's look at DLF as well. Q4 numbers. Anushi here with a brief on how the numbers looked. What stood out for you? Anushi.
Well, I'll talk about the operational numbers. Well, that's the big talking point for DLF. Now, pre-sales up over 39% in the fourth quarter at the mark of 2,000 crore of odd so. Its collections, which have reported a robust growth at 51% growth that we are looking at the levels of 3,320 crore. So, considering this pre-sales and collections growth that we've seen in the fourth quarter, if you take that in consideration and see the FY25 numbers, pre-sales were up around 44%. That's the new sales bookings at the mark of 21,223 crore, higher than the guidance of 17,000 crore, which the company had achieved in the third quarter itself. Do note that the bookings were expedited because of the launch of the Dahlias project, which led to these kind of jump that we are looking in new sales bookings. While if you look at collections, they were up over 36%. It's also the operating cash surplus which has seen an improvement of 128%, which again led to a net cash position to 6,848 crore as compared to 4,534 crore in the previous quarter. Now the expectation is for FY26 that they'll be launching 15% of their overall pipeline in FY26. So that would be something that is interesting to watch out for. Conference call slated later for today. So management commentary in terms of where the pre-sales are concerned is important to keep a track of, considering we are looking at a higher base for this year. Just quickly walking through the headline numbers, also seen about a 47% of a revenue jump this year. Margins stood at 31% as compared to 35%, and net profit saw around a 39% of an increase. So this is the overall perspective for DLF. It's a beat across the pre-sales and the collection guidance that we are looking for FY25.
Okay, so beat across the board. I want to quickly take it across to Aditya. Aditya, how does DLF look and some of the other realty players as well? If you have a quick view before I take a fundamental view from Nirav.
Oh, definitely. It's looking strong to me, Harsh. I think after a bit of a correction from the top, it's an opportunity to go long on DLF for a target of 800 to about 820 on the upside. Look to go long with a stop loss at 730 on the downside. One more stock that I would like to add in this space is an Oberoi Realty. That is also looking interesting to me. Excuse me. Again, a bit of a correction in the stock in trade today, providing an opportunity to go long for a target of around 1800 to about 1820 on the upside with a stop loss at 1660 on the downside.
Nirav, do you like realty, and what within realty? Because you have a Suntech up 2.5%, a Raymond up 5%. Any of those names on your radar? What's your preference?
Well, of course, we've liked stocks like Godrej Properties and DLF. DLF has reported a very strong set of numbers, and this is on expected lines. And I think they have pointed out earlier also that they have a very low cost land bank and a slew of launches which are there. We've already seen the super premium luxury offering, that is the Dahlias, and it has received a very strong response. And some more new projects are lined up. 15% of the the launch pipeline is slated for FY26, as you rightly pointed out. So I think DLF should continue to do well. We also like Raymond quite a lot because they've got around 100 acres of land with a gross development potential of around 25,000 crores. Plus, they have entered into joint development agreements for projects worth 14,000 crores. So I think 40,000 crores projects are slated to be executed over a period of time. So it's looking quite exciting. Most of it is largely low-cost inventory with potential for superior quality gains.
Well, this stock is obviously locked in upper circuit while we are at it, but yeah, that's one option which Nirav seems to like within the realty pack. Aditya, let me come to you very quickly. The Nifty is down now 1.1%. We've slipped below 24,700. What's the call with regard to the Nifty, the bank Nifty? What's the view on the index? What are levels you're looking at? Very quickly.
So if you're not long on the index or short on the index, completely avoid. I wouldn't trade both the Nifty or the bank Nifty. But you already have a position. In case you have a long position, maybe you can continue to hold with a stop loss at 24,540. For me, that is a key support level, 24,540. Till the time that holds, I think markets will remain in a range between 25,000 to about 24,500. As far as Bank Nifty is concerned, that is where I think the outperformance will come in the near term. So 54,500 to about 55,500, the 1,000-point range for the Bank Nifty is where I'm seeing the market consolidating. I don't see too much of a trouble in the markets going by today's down move because clearly for me, VIX is the key index that I'm watching out for. As I mentioned, till the time it is crossing 18, I'm comfortable in the market.
Okay, so those are views on the index. Aditya, your BTST for the day.
So I've got a buy on GAIL, a very interesting chart setup. Harsh looks quite a bit a long trade candidate for me from here on. So for a target of 200 with a stop loss at 185, I'll go for a BTST here.
All sectoral indices have slipped in the red now and for a while now. At least that's how it's playing out. Now, in terms of, there are one or two other stocks as well which are buzzing, and Quess Corp is one of those that we spoke about. Nirav, let me quickly come to you with regard to a Quess. Would you have a view? The stock is down 9%. Is this an opportunity to buy at this point?
Well, it's a very interesting space in the workforce and the staffing solution space. And I think this stock has been punished for a slight miss in terms of the performance. So I think this should definitely be used as an opportunity to enter into the stock at these levels.
Okay, and what do you make of something like a restaurant brands, Nirav? Would QSR has been, quite weak in that sense for a while now. The first signs of a zing, it seems. Do you expect this to be a sustainable theme which will last?
Well, I think QSR has been struggling for a while, and I think still we need to wait for a couple of quarters before we see really some tangible improvement in terms of numbers, and the consistency of that performance needs to be maintained. So I would be a little bit wary or cautious before making an entry into these stocks at this point of time.
Sure. Now, the other space that's buzzing is green energy. Quickly switching spaces as well. Inox Green surging on the back of order wins. Varsha joins us with details with regard to this one. 12%, Varsha.
Yes, absolutely, Harsh. So, if you see, let me just talk about the the recent order win that has been announced. So they've signed agreement to provide operation and maintenance services for 285 megawatt peak of solar projects. And now the next leg of growth for this company is of course the solar projects. Now the projects belong to two major Indian renewable energy companies located across multiple sites. Now this new agreement will increase their company's operation and maintenance portfolio to 1 gigawatt, and companies are rapidly adding solar assets to its portfolio. But on the growth strategy when it comes to Inox Green, they are targeting portfolio of 10 gigawatts in next 3 to 4 years. Their solar operation and maintenance potential is expected to reflect in FY26 revenues. And lastly, they are actively pursuing acquisition when it comes to stressed assets, which will come through the inorganic growth that they have been doing and they will be doing in the future as well.
Okay, so that's on Inox Green. Within the green energy basket, Nirav, anything that's looking good to you and any views with regard to an Inox Green?
Well, I think Inox Green has been quite aggressive, and the market is finally paying heed to their performance potential. We've seen the renewable energy projects pick up steam, especially in the recent past. And I think their strategy of being focused on the solar energy projects with very, very ambitious targets being set out. At the same time, focus on O&M, that is operations and maintenance, which tends to have superior quality margins. And the strategy of acquiring the stressed assets at throwaway prices, I think it can work very well for the company going forward. We also like KPI Green, and we like Adani Green Energy.
Okay, Nirav, the other one that's buzzing today is a Coal India. Does this look good? Of course, high dividend yield, PSU, generally a theme during the hot summers when electricity consumption goes up, and you'll start to see those numbers trickle through in Q1. What's the sense?
Well, I think Coal India, we are seeing some of the PSU basket getting widened, because we are seeing good action in Coal India. We've seen action in ONGC also. But I think, yes, it's looking good from a medium-term perspective, and especially in light of the fact that it could be a cash-rich company, and it can expect a better dividend payout as far as the company is concerned.
Okay, and Aditya, what about charts? How is Coal India looking on charts? Because it's holding up very well in trade on an otherwise very difficult day of trade.
Yes, Harsh. In fact, this was one stock which was on my radar to give a trade here. Good that we are talking about Coal India. I think it's a good trade to take after a correction from the peak. I think it's a good correction. It is a good trade to take long here for a target of 430 on the upside. I'm looking with a stop loss at 400 on the downside. 430 should be a target. You can definitely look at a long trade in Coal India.
2% correction in the auto index, Aditya. Anything looking interesting there?
Definitely, Harsh. In fact, I did mention about a two-wheeler name within the auto pack, that is Bajaj Auto, giving you an opportunity to go long. The second on my radar will be a Tata Motors stock. After a bit of a correction, up move is a little soft in trade today. I think that is an excellent opportunity to go long on Tata Motors at current levels. For a target of 800 on the upside, I would definitely look at going long here. The second four-wheeler name on my radar is Mahindra & Mahindra. Again, I think a matter of time before it breaks out into an all-time territory, high territory above 3,200. So again, in today's correction, it's giving you an opportunity to go long on Mahindra & Mahindra as well for a target of 3,400 on the upside. One should definitely look at latching on to these opportunities, both within the two-wheeler space, Bajaj Auto, within the four-wheeler space, Mahindra & Mahindra and Tata Motors.
Okay, some names for you. IndusInd Bank will declare numbers tomorrow, post-market. Plenty of things to look out for. You'll have derivative losses which have been understated, which will be booked. A profit after tax impact of around 1,580 or 1,600 odd crore. You will also see a discrepancy in accrual of interest within the MFI portfolio of around 600 crore. That will get impacted, or that will impact the numbers as well. This is a pre-tax number, mind you. Then you will have the microfinance portfolio and the recovery there, which will be in focus. Broadly, you're expecting a loss of around 320 odd crore. This is as per Bloomberg analyst estimates. This is complete, and it's difficult to call as to what that number will be. Nirav Ashar, is IndusInd on your list of stocks which you could likely find interesting at this point, given that valuations have compressed sharply?
Valuations may have compressed, but the problems have compounded. So I think we've exited this stock a long time back.
Aditya, your take on IndusInd, yes or no?
Yes, if you're a brave heart.
Oh, brave heart. Okay, and what are the levels you look out for?
I think it's giving you a good risk to reward. So with a stop loss somewhere on 700, maybe you can look for a target of 950 on the upside.
Okay, thank you so much, gentlemen, for coming in, giving us all of those views. We'll let you go on that note. It's been a packed day per se with the way in which markets have moved, because we're now down 1%. We're just about a minute and a half from close, but we're down 1% on the index. We're holding 24,700 somehow. But when you're looking at it intraday, there's sustained weakness all through the day that we've seen. and we are just off the low point of the day, at least for now. We're around 50 odd points from the low point of the day. Okay, so that's on the Nifty. Let's look at the heat map on the Nifty 50 as well. Breath looks tough on the Nifty. It just gets worse as the day has progressed. Couple of PSUs in focus, Coal India and ONGC, two of those. You're seeing a decent uptick in a Tata Steel, which is holding up very well on a day like this. You're also seeing Hindalco on the back of numbers make that 1% move. Outside of that, it's just a coat of red across the board. Auto stocks are the ones which are in focus and under pressure. Hero, Bajaj, Maruti are three of those languishing within the top or the bottom five of or the top five losers on the index today. But that's how it's playing out. Let's look at the advanced decline as well in terms of the market breadth overall, and that's also looked difficult and keeps getting more and more tough as the day has gone by. We're now seeing nearly 3:1 on the advanced decline in favor of the declines, and it was a choppy start to the day, at least with regard to this, and therefore the Nifty mid cap and small cap, you'll get direction straight from here. The Nifty mid cap also under pressure, 1.5% lower, in fact underperforming the index today. The Nifty small cap outperforming, but just about marginally, 0.8% lower. Again, both of those just off the day's lows, but that's where the pressure continues. It's been a couple of days or a few days where the Nifty mid cap and small cap indices have actually outperformed the Nifty 50. Today, not one of those days, clearly. Let's look at sectors as well. Auto likely languishing right at the bottom. IT, metals for a large part of the day was in the green, by the way. It's down as well now, 0.3% lower at close. Nifty Defense is the top loser of the day. Outside of that, the consumption index saw some pressure. You saw pressure on the pharma index as well as the Nifty Media. Those were some pockets where there was pressure. FMCG largely in line with how the Nifty 50 performed. IT and metals stood out for a better part of the day, but have closed in the red. That's how it's played out. Let's pull up the BSE 500 top gainers, top losers as well. And HLE Glasscoat on the back of those fantastic numbers. Pfizer as well. BASF is up 8.5% at close. Restaurant brands again on the back of numbers. Raymond just another day at the office, 5% higher. Quess Corp again on the back of everything that's playing out and numbers. Cochin Shipyard, some pressure coming on the back of the defense space being under pressure. Then you have HEG again on the back of numbers. So plenty of movers on the back of numbers on this list. Quickly on to what to watch out for tomorrow. In terms of global, those are the two Qs, but smaller ones. Let's look at the other ones. Yes, you have Page Industries. You have an interim dividend of 200 rupees per share coming. There's an IPO offering, Bellrise, which will come out with a fresh issue of 2,150 crore within that 85 to 90 rupee band. Watch out for this one. Again, some bit of zinc coming through. And Zinca Logistics will also be in focus as the anchor lock-in opens. So IPOs, again, there's plenty of moves happening now. It's just about starting. Let's look at some names to look out for on the back of earnings. I'll have my eyes on an IndusInd Bank. Plenty to talk about over there. You'll also want to watch out for the con call. PFC will be the other one within the financials basket, which will be in focus. Outside of that, within the consumption basket, a Colgate, a Protean eGov will be in focus. What to expect in terms of numbers going into FY26, that will be in focus. Uno Minda within the auto space. Star Cement, Gokaldas, Nalco are just some of the others, along with an NTPC Green, which will be in focus. But for today, completely out of time on this edition of India Market Close. From Hiral, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with.
Hello and welcome. You're watching Market Express and I'm your host Himakshi Bahugna. Now let's get straight to the show. Here's in a volatile day of trade. The Nifty dropped over 200 points, dragged by HDFC Bank. The Sensex has dropped by more than 700 points. Telecom stocks weighed on the Nifty 50 the most. Weak global cues, uncertainty over the Indo-US trade talks and high valuations of stocks pushed foreign investors away. Almost all sectors traded in the red, led by FMCG, auto and financials. Another reason for the drop was the spike in the 20-year Japanese government bond yield. Yield surged to the highest level since 2000. Rupee closes 24 paise lower against dollar at 85.64. IDFC First Bank is in talks with domestic institutional investors to allay any concerns over the appointment of a non-retiring director from Warburg Pincus on the board. Now, according to people in the know, conversations with domestic institutional investors have already begun. On Monday, institutional investors voted against a proposal to appoint a non-retiring, non-executive representative from Currency Investments on IDFC First Bank's board. And giving you another exclusive, in a bid to make its IDBI Bank acquisition offer more attractive, Emirates NBD has decided to deploy a wholly owned subsidiary in India. While Emirates NBD India has been active for some years with 3 branches in India, it received an in-principle nod from the Reserve Bank of India to set up a wholly owned subsidiary. Now, this would be through conversion of its existing branches in Chennai, Gurugram and Mumbai. Shareholders approve a 49.5% cap on foreign ownership for Eternal, aligning with its inventory-led model focus. Now, this triggers MSCI and FTSE passive selling with potential outflows of $1.4 billion over multiple quarters. Now, MSCI's weightage halves. Domestic ownership rises to 23.5%. supporting data localization and inventory control, but the model demands higher capital and operational efficiency. Quess Corp shares dropped 10% despite strong quarter 4 of FY25 results, reporting a net loss of 95 crore due to demerger related expenses and an exceptional loss of 158 crore rupees. Margins fell below guidance impacted by lower sales and an unspecified IT incident raising transparency concerns. Now, the drop was also led by liquidity concerns with cash levels at a 6-quarter low and a 120 crore impairment charge on trade receivables. DLF shines in quarter 4.
crushing FY25 guidance. Net profit skyrockets, led by robust pre-sales from the Dahlia's project. Collections soar and the net cash position strengthens to 6,848 crore rupees. The company also proposed a dividend of 6 rupees per share. During their post-earnings con call, BEL stated that they are expecting 15% revenue growth in FY26 with margins at 27% and capex exceeding 1,000 crore. Now, over the next 5 years, revenue growth is projected at 15 to 17% with a major order for next generation Covetus expected this year. BEL also plans to increase exports revenue by 15% to $120 million with 20% growth projected from next year. Protean eGov was eliminated from the PAN 2.0 project despite earlier confidence, leading to a stock decline of 7% after hitting a 52-week low. Acquirers downgraded the stock to sell, cutting the target to 900, citing risks as PAN services contribute 50% of revenue. Analysts are expecting a 75 to 100% revenue collapse over the next 2 to 3 years, with a 35% decline in FY27 overall revenue. PNB Housing Finance approved issue of non-convertible debenture of up to 400 crore rupees through private placement. The NCDs carry a coupon rate of 7.53% per annum. While the specific use of proceeds was not detailed in the announcement, such issuances are typically used to fund business growth, manage liquidity, or refinance existing debt. Shares of Zydus Life Sciences fell in Tuesday's session after the company reported a weak fourth quarter. Now, the profit declined by 1% to 1,170 crore rupees. Revenue and EBITDA clocked an increase of 18% and 30% respectively. ICICI Securities upgraded Zydus Wellness to buy rating. The brokerage said that Zydus Wellness's Q4 FY25 organic performance was good. Best-in-class revenue growth of around 12%, driven by 7% volume growth. The brokerage also added that while unseasonal rains may impact Q1 of FY26, improved execution may trump this challenge. And in the medium term, portfolio premiumization may support margin expansion. Shares of Vali Energies hit nearly its one-month high levels on Tuesday. Now, this comes after the company's board approved the 293 crore rupees acquisition of Kamath Transformers. Now, Kamath Transformers was incorporated in 1996 and is into manufacturing transformers. In financial year 2024, the company posted a turnover of 122.68 crore rupees, while in fiscal 2023, it had reported a turnover of 54.41 crore rupees. Hindustan Foods posted a good quarter, reflecting a strong growth in ice cream and beverages. The shoe business of the conglomerate also turned operationally profitable. It expects a 3 times higher capital turnaround after it completes its full capital expenditure. Margins were, however, due to higher employee and depreciation costs. Pfizer's shares price surged over 12% to 4,990 rupees after reporting an 85% jump in Q4 of FY25. Net profit versus last year to 330.94 crore rupees. Revenue grew 8.3% to 591.91 crore rupees, while EBITDA rose 20% to 227.5 crore rupees, with margins expanding to 38.4% from 34.7%. Now, the company announced a final dividend of 35 rupees per share. Now, the rally was also supported by recent sales and marketing packed with Mylan Pharmaceuticals for 2 brands, and that makes it the stock of the day as well. Now, NLC's fourth quarter revenue grew by over 8% on an annual basis. The company received its all-time highest ever coal production. Net profit was mostly led by other income. Now, lower other expenses aided EBITDA margin. The consolidated profit of the company almost tripled from 114 crore to 482 crore rupees. Eris Life Sciences reported a 28% year-on-year revenue increase to 705.3 crore rupees in Q4, despite a marginal slip in insulin revenue execution. EBITDA surged 70% to 252 crore rupees, with margins expanding to 35.8% from 26.9% due to operating leverage. Now, net profit also grew 32% to 93.8 crore rupees, though impacted by higher depreciation, interest costs and taxes. Margin expansion was also led by operating leverage. Acme Solar reported robust Q4 with over 65% year-on-year revenue increase to 487 crore rupees, driven by a 1200 megawatt capacity addition. EBITDA doubled to 488 crore rupees, with margins expanding to 89.5% from 68% due to operational efficiency. However, net profit fell above 76% due to lower other income. The company commissioned phase 2 of a Rajasthan project and aims for a 10 gigawatt portfolio by 2030. DOMS Industries reported a good quarter, with revenue rising by 26% and net profit surging over 7%. But the margins, however, slipped slightly to 17.4% from 18.8% earlier, and this was due to rising depreciation cost, employee benefits and higher other expenses. And as per an NDTV Profit exclusive viewer, SEBI is exploring to expand its regional offices. And the primary reasons for prioritizing its regional expansion is to extend its contribution to investor protection and education, preventing frauds in Tier 2 cities, and also provide more career opportunities to people from deeper parts of India. And in the latest on the Gensol engineering scam, we understand from sources that the Corporate Affairs Ministry plans to finish the probe in the company and its 18 affiliated firms soon. The aim is to, conclude the probe in a beleaguered company in 3 to 5 months. Also, if enough evidence is found, the MCA can go ahead without involving the Serious Fraud Investigation Office. India is preparing to open up a new Wi-Fi channel known as 6 gigahertz band, which could make a big difference to streaming, working, learning and general connectivity. The Department of Telecommunications has already put out draft rules to de-license the 6 gigahertz frequency. At present, India mostly uses lower frequency Wi-Fi of 2.4 gigahertz and 5 gigahertz. In conversation with NDTV Profit, Hitachi Energy's MD and CEO N. Venu highlighted strong growth in transmission, renewable energy and data center sectors that outperformed the market, with exports contributing about 25% of revenue and boasting better margin profiles than the domestic market. The company plans to maintain a sustainable export strategy while keeping the domestic markets as its main focus. H-1B visa applications have dropped, reflecting reduced hiring appetite among US firms. The global layoffs have led to fewer registrations, impacting professionals seeking work opportunities in the US. Additionally, the high application fees are discouraging new applicants, further contributing to the downturn. Macquarie is bullish on Sun Pharma. It maintains outperform rating and hikes target to 2,135 rupees. Now, the brokerage sees Sun Pharma's checkpoint bid seen as a strategic win. It expects the bid to increase the pharma company's profitability. It also believes unlocks it as a strong, solid strategic fit too. It reckons that unlocks it fills crucial gaps in Sun Pharma's derm onco portfolio. Hindalco's Q4 net profit surged by 41.4% versus last quarter to 5,283 crore rupees, surpassing expectations. Revenue grew 11.1% to 64,890 crore rupees, while EBITDA rose 16.5% to 8,836 crore rupees. Margins improved to 13.6% from 13%. The company announced a dividend of 5 rupees per share. Strong performance reflects robust operational efficiency and favorable market conditions. Max Healthcare reported a 34.2% year-on-year revenue growth of over 1,900 crore rupees in Q4, with net profit rising 27% to 319 crore rupees. EBITDA grew 34% to 511.62 crore rupees, though margins slightly dipped to 26.8% from 26.9%. Now, the company announced a final dividend of 1.5 rupees per share. Strong operational performance drove the results despite stable margins. Interglobe Aviation is expected to report over 21,800 crore rupees in revenue, which is a 23% higher compared to last year. Now, adjusted EBITDA is seen to be up 27% at more than 5,200 crore rupees, and net profit is estimated to grow 36% to 2,574 crore rupees. Now, the earnings will be driven by higher air traffic, better fares, and lower fuel costs. EBITDA is projected to rise 29% to 5,876 crore rupees, with margins improving to 26.8%. Key factors include favorable air traffic due to Mahakumbh's stable rupee and reduced crude prices, offsetting higher airport charges. Investors should monitor geopolitical impacts, FY26 guidance, aircraft delivery risk, and updates on business class and loyalty programs. Kotak came up with a note on Q4 earnings. The brokerage noted that Q4 earnings for FY25 were subdued, with Nifty 50 earnings growing just 4.8% year-on-year despite rich valuations. Banks and downstream oil marketing companies outperformed while most sectors faced challenges. Now, consumer companies saw weak volume growth, margin pressures, and muted demand. Investment companies reported margin issues, and banks noted sluggish credit growth. IT services highlighted weak demand, reflecting a cautious economic outlook across industries. CLSA upgrades Amber Enterprise to outperform from hold, signaling confidence in its growth trajectory. The firm raises the target price to 7,275 from 7,000 rupees, citing strong Q4 performance in line with estimates. Robust growth guidance and an uptick in non-AC segments drive optimism. CLSA notes that PLI scheme will enhance return on capital employed, while margin and return improvements stem from expansion beyond ACs. Amber's diversified growth strategy is the key focus. Inox Green Energy signs a pact for operations and maintenance of 285 megawatt peak solar projects, expanding its O&M portfolio to approximately 1 gigawatt. The projects belong to two major Indian renewable energy firms. Inox is rapidly adding solar assets, reinforcing its growth strategy. HEG reports sequential revenue improvement, reflecting business stability. However, EBITDA takes a hit due to rising raw material costs and low graphite electrode prices, impacting margins. Additionally, other expenses increase amid a decline in fair value of investments, adding pressure on earnings. Low price competition from China remains a key concern, potentially affecting the profitability in the coming quarters. On to some national news now. Following Operation Sindoor, the beating retreat ceremony or lowering of flags at Wagatari, Hussainiwala and Sadki joint checkpost of the Border Security Force was stopped on May 9. However, with the easing of tensions between India and Pakistan, the retreat ceremony will resume today. NCP's Chhagan Bhujbal was sworn in as the minister in the Mahayuti-led Maharashtra government. State Governor C.P. Radhakrishnan administered the oath. Chief Minister Devendra Fadnavis was present at the swearing-in ceremony. Along with his deputies Eknath Shinde and Ajit Pawar, Bhujbal replaces Dhananjay Munde, who resigned in March over allegations involving his aid in the murder of Sarpanch Santosh Deshmukh. Maharashtra government announces new housing policy, announced with the motto of My Home, My Rights, or Mera Ghar, Mera Adhikar. A comprehensive program of slum rehabilitation to redevelopment will be carried out with an investment of 70,000 crore rupees. Specific needs of low-income earners, senior citizens, women, industrial workers, and students will be prioritized under this policy. Now, the program will be implemented by Housing Department. The COVID scare appears to be making a comeback, with India logging 164 fresh cases since May 12. India currently has 257 active cases, with Kerala, Maharashtra and Tamil Nadu leading the number rally. In the past week, Kerala reported 69 new cases, Maharashtra logged 44 and Tamil Nadu added 34 cases. Maharashtra also reported 2 deaths, which according to doctors are not COVID-19 deaths, but both patients were found to be COVID-19 positive. Not just India, a resurgent wave of COVID-19 is spreading through Southeast Asia, with densely populated regions in Hong Kong, Singapore, China and Thailand witnessing a spike in cases. Health authorities are on alert in major cities like Hong Kong and Singapore. China and Thailand have asked people to take new booster vaccinations. Bharti Airtel and Google announced a partnership that brings a compelling Google One cloud storage subscription service for Airtel customers, helping address the mounting challenge of limited device storage. All postpaid and Wi-Fi customers will get access to 6 months of 100 gigabyte Google One cloud storage at no extra cost. Now, they will also be able to share the storage with up to 5 additional people. A Delhi court has acquitted 12 men accused of murdering a man during the 2020 Northeast Delhi riots, citing the prosecution's failure to identify the perpetrators or establish their role in their killing. The accused were tried of the murder of Amir Khan, whose body was recovered from the Bhagirathi drain of Gokulpuri on 27th of February 2020. A post-mortem examination had revealed 25 injuries on his body. Dakshina Kannada and Udupi district administration asked fishermen not to venture into the sea until May 23 due to adverse weather conditions in Karnataka. They also asked the fishermen at sea to return to the ports. The IMD issued a red alert for coastal Karnataka until 8:30 a.m. on May 22nd. Eastbuy Trip CEO Nishant Pitti has denied allegations of being aware of Sky Exchange's activities linked to the Mahadev betting app. Now, news reports say that ED is probing Eastbuy Trip CEO Nishant Pitti in the Mahadev betting app scam and making payments to shell companies. The Indian Meteorological Department has warned of heavy rainfall across states. These states include Kerala, Tamil Nadu, Puducherry, Karaikal, Konkan, Goa, Central Maharashtra and other until 24th of May. China's benchmark lending rates were lowered to 10 basis points after the nation's central bank cut its policy rate to stimulate domestic demand. The People's Bank of China revealed that the one-year loan prime rate was lowered to 3% and the 5-year rate was reduced to 3.5%. Now, this marked the first cut to benchmark lending rates for the year, following a series of monetary easing measures by Beijing. China's fourth biggest state-owned bank said that they will lower deposit rates by up to 25 basis points. And now the latest on the Russia-Ukraine conflict. President Donald Trump is making fresh moves to push for peace talks. Speaking to the press, he emphasized that the US is not stepping back from efforts to stop the war and revealed that he's reached out to Russian President Vladimir Putin. Meanwhile, Ukrainian President Zelensky says that Russia is preparing new demands in a memorandum that will soon be shared with Ukraine. He hinted at broader negotiations involving the US, the EU, the UK, and possible venues including Istanbul, the Vatican, or Switzerland. Zelensky reaffirmed that Ukraine will not withdraw its troops but expressed hope that the path forward will become clearer soon. In a shocking Premier League upset, Liverpool suffered a 3-2 defeat at the hands of Brighton at Anfield. Despite taking the lead twice, the Reds couldn't hold off a determined Brighton side who sealed the win with a dramatic late goal. Manchester United is set to activate the $62.5 million release clause for the Brazilian forward Matheus Cunha. Cunha has impressed this season with 17 goals and 6 assists in 34 appearances. Personal terms are reportedly close to being finalized, with the official move expected after the season concludes. Veteran actresses Shamila Tagore and Simi Garewal attended the screening of Satyajit Ray's film Araner Din Ratri on day 7 of the Cannes Film Festival 2025. They both walked the red carpet at the film's premiere and graced it. Shamila Tagore wore a stunning green sari, while Simi Garewal walked in the red carpet in an ivory dress. The 1970 film premiered at the Cannes Classic section. And as we move into tomorrow's trade, keep an eye on Japan's balance of trade, Canada's consumer price index on the global front. Also keep in mind the dividend announcement of Page Industries of 200 rupee per share. Belrise Industries will be open for subscription and Zinca Logistics will exit its anchor lock-in period. Well, with that, viewers, it's a wrap on Market Express, but stay tuned to NDTV Profit as there's more lined up ahead for you all.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims?
Benchmark equity indices plunged sharply. The BSE Sensex falls 872 points, barring Tata Steel, Infosys and TCS. All the other constituent stocks of the Sensex end in the red. IDFC First Bank in talks with domestic institutional investors to allay any concerns over the appointment of a non-retiring director from the Warburg Pincus on their board. In a bid to make its IDBI Bank acquisition offer more attractive, sources say Emirates NBD has decided to deploy a wholly owned subsidiary in India. Sources say the MCA probe against Gensol will be completed in 3 to 5 months, adding that there may not be a need to send the case to Serious Fraud Investigation Office if MCA gets enough in its investigation. Markets must work for many and not just for a few, reiterates Union Finance Minister Nirmala Sitharaman, adding that a sudden spike in the electronic way of doing business and digital commerce globally poses new challenges for competition watchdogs to protect the free market spirit. In a significant move, the Maharashtra Cabinet approves a new housing policy, My Home, My Rights, with an investment of 7,000 crore rupees, which will aim for slum rehabilitation to redevelopment. With 164 fresh COVID cases reported since May the 12th, India sees a rise in cases and currently has 257 active COVID-19 cases, with Kerala, Maharashtra and Tamil Nadu leading the number tally. Good evening. You're watching Profit 360 on NDTV Profit. I'm Sanjana, bringing you the latest updates. Over the next 30 minutes, we'll dive into the biggest market movements along with top national and international headlines. So let's take a look at how the markets fared today. Investor sentiment took a hit as both the Nifty and Sensex plunged over 1%, marking a broad-based sell-off. All sectoral indices closed in the red, with a staggering 43 out of the Nifty 50 stocks ending lower, signaling widespread weakness across the board. Harsh now joining in with a complete wrap of the day's market action.
Well, markets have taken a bit of a breather. In fact, more than a little bit of a breather today. 1% lower. We're well off the 25K mark now. We're now staring at 24,700 in fact today. And there were signs that we could be bracing for some bit of more pressure, because we slipped below 24,700 and thereafter closed just above it. So around a percent shaved off on the Nifty. But given the kind of rally we've seen, not much to worry about. Let's look at stocks which were in focus. BL had numbers which came out within the Nifty pack. That was one of the stocks which were in focus. But outside of that, Coal India and ONGC were two of the three top gainers on the index today. Hindalco on the back of numbers was in focus, and that's the other one which was perked up a percent in trade. A strong set of numbers coming through on Hindalco. Let's talk about the stocks which are languishing at the bottom, and the larger theme there was auto. Bajaj Auto, a Maruti, a Hero. Three of those were part of the top 5 losers on the Nifty 50 index today. So those stocks under pressure, and of course, therefore, the Nifty Auto index was down nearly 2% because you saw that pressure on the Nifty Auto. Outside of that, defense was under pressure. A Cochin Shipyard was down 8%, and some of the other defense stocks, something like a Zentech, a Data Patterns, all of which had zoomed or have zoomed for a while now, saw some pressure and some cool off coming in on the Nifty defense. 2.25% lower on the Nifty defense as well. So that was the other pocket which saw some pressure. Outside of that, the outperformance was shown in the Nifty metal, where China actually cut its lending rates, and you saw the Nifty metal for a predominant part of an otherwise weak day sit in the green. It closed in the red though, around 0.3% lower, and so was the case with the Nifty IT. So Nifty IT and metals, even though they outperformed, you saw some pressure right towards the fag end, and that was the case even when it comes to the advanced decline in the breadth. The breadth was difficult right towards the end. It was 3:1 in favor of the reds, and therefore you saw some pressure creep through even on the Nifty small cap and mid cap index. Both of those indices, the Nifty small cap largely in line with the Nifty 50, around 0.8% lower, but the Nifty mid cap was where some real pressure was getting built in, 1.5% lower at close. In terms of big movers on the BSE 500, largely focused on certain specific names where there were moves. You saw Pfizer up 11, you saw an HLE Glasscoat which was up 20, locked in upper circuit. So a couple of those names were zooming in trade, and so did the ones which didn't do as well. Some of them were on the back of numbers.
Thanks for that, Harsh. And shares of Eternal, previously Zomato, also dropped nearly 4% today after shareholders approved a foreign ownership cap of 49.5%, raising questions about its potential impact on investor sentiment and future capital inflows. How will this decision shape the company's long-term strategy, and could it influence market confidence or investment dynamics? Mahima joining in now with deeper insights.
So as you rightly mentioned, shareholders have now approved the fact that board did approve earlier that 49.5% is the cap to FI holding in Zomato. The board of directors had already approved that, and now shareholders have come out and given the approval on the same. Now, in terms of how this impacts overall, in terms of how funds will flow out of Zomato, plus how it will change in terms of the way Eternal will work. Firstly, it will trigger the MSCI and FTSE passive selling. Selling could be as much as $1.4 billion in multiple quarters. In terms of MSCI details, current weightage is around 1.3 times. This will become half, and outflow will be anywhere around $600 million to $800 million. For FTSE, the current weightage is around 1.17. The outflow could be anywhere between $500 million to $600 million after review. And first review will happen in June 2025. After that, every quarter will see outflow of around $70 to $100 million. In terms of what this means for Eternal, last QIP where Eternal raised around 85 billion, there was an increase in terms of domestic ownership which was seen. 8% overall was subscribed by domestic funds. Post the QIP, FI ownership fell to around 47%. DI ownership increased to around 20%, and currently DI ownership stands at around 23%, and FI ownership continues to fall, and now it is at 44%. Increased domestic ownership aids basically your data localization norms, your control over inventory, as well as safeguarding local consumer data. Plus, inventory-based model will be adopted by Eternal going forward, and better control over product quality and pricing will take place. Higher margins through bulk procurement could be one of the factors that could work positively in favor of the company, and easier promotion of private label could also take place. But challenges, of course, this comes with a lot of challenges, including requiring of stronger grip over operations, plus requires high working capital, and plus there could be risk of unsold and obsolete inventory as well. So this is the overall view as to how and what this means for Eternal exactly.
Thanks so much for that. And sources now indicating that Emirates National Bank of Dubai, that's known as Emirates NBD, is considering acquiring IDBI Bank through a wholly owned subsidiary, a move that the lender believes is strategically well placed and simpler compared to other potential acquisition structures.
Right, so the Reserve Bank of India gave its in-principle nod to Emirates NBD to open a wholly owned subsidiary in India. Of course, remember that the wholly owned subsidiary model exists, has been in existence since 2013, but most foreign banks have actually kept away from it. Now, what is happening with Emirates NBD is that according to the bidder, it will be easier to acquire IDBI Bank if a wholly owned subsidiary exists in India, and that is exactly why they are going for it. Remember that the wholly owned subsidiary model is only one way of how foreign banks can actually operate in India. The other way is through a branch system where essentially the foreign bank is the owner and it opens branches in India. Currently, Emirates NBD has about 3 branches in India, one in Chennai, Gurgaon, and then in Mumbai. And once this wholly owned subsidiary model has been approved fully by the Reserve Bank of India, and if the IDBI transaction goes through, then of course Emirates NBD will hold that entire franchise of IDBI Bank in India. Currently, they are in competition with Fairfax for this acquisition. Fairfax, of course, if you know, is a Canadian investor led by Prem Vatsa. He's a billionaire. Fairfax already currently owns a bank in India through CSB Bank, and it has to enter complicated transactions to be able to acquire IDBI Bank, and that is why Emirates NBD believes that a wholly owned subsidiary model will make it easier for them to be eligible for IDBI Bank. All in all, both bidders are currently still concerned about the way employee unions at IDBI Bank will react to the news of a foreign lender buying IDBI Bank. That is something that they have expressed to the government as well. If any further delays are caused because of this employee union, then that may cause some trouble in the sale of IDBI Bank.
Thanks so much for that. And moving on to another top story that we've been tracking very closely, the Ministry of Corporate Affairs is pushing to wrap up its probe into Gensol Engineering and its 18 affiliated firms within the next 3 to 5 months, is what sources are saying. Now, the investigation is centered on corporate violations, including alleged fund diversion and misuse, raising serious concerns about governance and financial integrity. Rishabh Bhatnagar joins us now with exclusive insights from his sources.
What we're picking up from sources within the Ministry of Corporate Affairs is the fact that the investigation into Gensol Engineering and the various affiliated companies is broader than we earlier expected. It will now cover about 18 companies, that is excluding Gensol. So the broader investigation now covering and spanning about 19 companies. What the MCA sources are telling us is the fact that they aim to conclude this investigation within 3 to 5 months, and that is purely on the basis of the evidence that they have. What is felt within the government is the fact that since this case is very recent, it's very hot currently, so they will be able to find evidence and they will not have to sort of confer with the SFIO, which is the Serious Fraud Investigation Office, and they can unilaterally pick it up and wind this investigation down within 3 to 5 months. Separately, what what we're also hearing from the MCA is the fact that they are planning to table an amendment to a section of the IBC, of the Insolvency and Bankruptcy Code, that requires companies that are moving for insolvency to obtain CCI approval prior to approval of the resolution plan by the Committee of Creditors. They are planning to do away with this, and we expect that this amendment will be tabled in this monsoon session. So that is the recent on what we're picking up from sources within the Ministry of Corporate Affairs.
Meanwhile, at a CCI event, Finance Minister Nirmala Sitharaman underscored the importance of balanced regulations amid global economic challenges, highlighting ongoing structural reforms and the push for streamlined merger processes. She also pointed to how regulatory delays impact trade negotiations with different countries and investor confidence.
In an export-challenged, environment-challenged, energy-challenged, and emission-challenged world, the increased reliance on domestic growth levers requires ensuring the right balance of regulation and freedom. India's ongoing structural reforms, whether it is asset monetization, disinvestment, and digital public infrastructure, all are geared towards unlocking market potential and deepening competition. So in this year's Union Budget, I had mentioned the importance of a light-touch regulatory framework based on principles and trust to unleash productivity and employment. In the same vein, regulators must be guided by the principle of minimum necessary, maximum feasible in order to balance regulatory vigilance with a pro-growth mindset. In today's interconnected and fast-paced economy, delays in regulatory clearance can lead to uncertainty, disrupt commercial timelines, and potentially erode the intended value of transactions. And globally, it has an impact even as we negotiate free trade agreements with different countries, because the ability, the nimbleness, and the readiness of our regulators is very keenly watched by investors. There is no need for me to underline the importance of that. But that has a very serious connotation when you're looking at fairly within reasonable time agreeing on some free trade agreements. So whether it is litigation, whether it is time consumed in litigation, or whether when regulators are less transparent, negotiations can get complicated.
And on the sidelines of the 16th annual day of the CCI, NDTV Profit's Rishabh Bhatnagar spoke exclusively with CCI chairperson Ravneet Kaur. The discussion covered its role in the free trade agreements negotiations, exploring how competition policy influences international trade deals. Additionally, Kaur shared her views on the ongoing investigation into Gensol Engineering, addressing key concerns surrounding corporate governance and regulatory oversight.
We have these free trade negotiations which are going on, and in the free trade agreements there is normally a chapter on competition. So the competition chapter in these free trade agreements is negotiated, and we already have the India-UK FTA, which has now come into force, and we have a competition chapter in that as well. So as and when there is any requirement for new negotiations to be held on bilateral trade agreements, CCI would be contributing to that.
Ma'am, we've seen CCI act very nimbly with regards to quick commerce as well as e-commerce with the cost of production regulations as well. What exactly is the aim of these as we go ahead now?
No, the cost of production regulations are meant to provide clarity and ensure that there is consistency in how cost is determined by the Commission, and then to come to the further findings if there are any anti-competitive practices being followed by the companies.
Lastly, ma'am, the hottest case right now is, of course, Gensol, BlueSmart. What's the sort of progress, and now how is CCI involved in this case now?
The Gensol matter, CCI is not involved with it. It is NFRA, NAFRA, which has received a reference from SEBI, and the preliminary examination is going on.
And in a landmark move, Maharashtra has introduced its new housing policy, Mera Ghar, Mera Adhikar, aimed at tackling housing shortages through slum rehabilitation and redevelopment. With a 70,000 crore investment, the initiative is expected to transform urban housing landscapes and provide long-term solutions for vulnerable communities. What does this mean for residents, developers and policymakers? Abhishek from NDTV joins in now with key insights.
It is a good news for the people of Maharashtra. Maharashtra State Cabinet has approved the new housing policy for the state, and it has the concept of my house, my rights. You know, on that line, it has been conceptualized, the entire policy. And if we talk about implementation of policy, around 70,000 crores have been kept. And this is the policy which is coming after the 2007 policy, which was the last policy decided by the government on housing. And when it comes to what will be there in the policy, you know, it will be inclusive policy for all. For example, affordable housing, rental housing, and using important and modernized technology for construction. And most importantly, lower income group, senior citizen, women-centric housing. You know, these are the new criteria that have been added, and the government is focusing on these areas. Definitely, when we talk about housing for all is the base from where this policy has been formed, and it is looking forward in the lines to give housing to everyone possible, and right from affordable housing to the rental housing, and looking forward to creating land banks across the state of Maharashtra. So most important to understand out here is definitely this new policy will be a game changer for the people who are looking forward to their dream homes in future.
India is gearing up to introduce the 6 gigahertz Wi-Fi band, a game-changing move for streaming, remote work, online learning and overall digital access. Now, this upgrade promises faster speeds, lower latency and improved network efficiency, reshaping the country's internet landscape. What will this mean for consumers and businesses? Aishwarya joins us now with more insights.
Well, just to set the context, currently, if you're using Wi-Fi in your homes, in your office spaces and public spaces, it is probably 2.4 gigahertz or 5 gigahertz of bandwidth. Now, what the government has done with the rollout of delicensing the 6 gigahertz bandwidth draft is that this will enable us to have faster connectivity. It will also enable faster video calls, gaming, as well as 4K streaming, which was earlier, of course, possible, but at a lower speed, there was some sort of latency involved. Now, this upgrade will also help Wi-Fi 6E as well as Wi-Fi 7 being brought into the market. Now, the devices will be tuned, of course, and we'll see how that goes further. What it also does is it supercharges the internet, and also it is ready for AR, VR, as well as smart home devices that you may see in the market currently. Now, the indoor Wi-Fi, according to the draft, has been capped to 30 dB, which is a little technical, but what it essentially does is helps in reducing interference between neighboring Wi-Fi devices. As far as 6 gigahertz is concerned, it is open to public. There is no license needed, but it cannot be used on cars, boats, planes, oil rigs, or even drones, and is just limited to local ground use. Now, what this does is puts India on the map of the 100 countries that have opened 6 gigahertz spectrum already. And the government wants, of course, like I mentioned earlier, feedback on this by the 15th of June. So far, that's the update. The pre-6 gigahertz and the post-6 gigahertz era is going to be different, especially for those who want to use certain devices that don't match the bandwidth currently.
Thanks so much for that, Aishwarya. And now the number of H-1B visa applications received by the US Citizenship and Immigration Services has fallen by 25% for FY26. Now, this decline comes as macroeconomic uncertainty drives layoffs, while high application fees continue to deter applicants. Haripriya now joining us with more details.
H-1B visa applications for 2026 have dipped significantly by 25% to 3,58,737. Last year, this number was at about 44,900. From the total registrations this year, about 1,20,141 have been accepted, which is again lower than 1,35,000 odd that were accepted last year. US typically issues 85,000 H-1B visas every year. H-1B visas are the non-immigrant visas which allows skilled workforce to pursue a job in the US. Majority of the H-1B visa holders are Indians. For instance, 72% of the visas issued in 2023 were to the Indians. Mostly the Indian tech workforce depends on this to go and pursue opportunities in the US. The tech companies in the India and US both exercise this visa. In this context, the dip in the registrations is seen when there is a lot of inconsistency in the job market and there's a lot of uncertainty. We see that multiple tech giants are laying off. The most recent being Microsoft laying off 6,000 employees, Amazon laying off 100, and other companies like Intel, CrowdStrike have also laid off employees in the recent past. Another reason for the dip is also that the registration fees has been hiked significantly. In the previous US administration, that's Joe Biden administration, the fees had gone up from $10 to $215. Now with the new Trump administration coming in, there is a lot of uncertainty around the immigration policies and what it means. That's also causing a lot of confusions and concerns for the people who are looking to shift to the US for the jobs.
Absolutely, Haripriya. Thank you so much for that update. And moving on, after months of relative stability, India is witnessing a slight uptick in coronavirus cases with 164 new infections reported in the past week, bringing active cases to 257. Now, leading the resurgence are Kerala, Maharashtra and Tamil Nadu. And while the numbers remain low, health experts advise staying informed, following safety guidelines and maintaining precautionary measures. Sujata now joining us with more updates.
Amid a slight rise in the COVID-19 cases in parts of India and abroad, Maharashtra stands at the second place with almost more than 50 patients that have been reported positive of the COVID-19 disease. And at this point, it is the BMC which has reassured its people that there's no situation to worry. And even if a rise in a number of cases have been noticed, BMC is fully prepared with its COVID wards, which has been specially designed to take care of these COVID-19 positive patients. In the recent days, we saw where 2 patients admitted in KM hospital. They died, but the reason behind their death was not COVID. They were COVID positive. However, the reason behind their passing away was that one was diagnosed with cancer, while the other was facing a kidney failure ailment. And at this point, the BMC has assured that all of the hospitals, especially the BMC hospitals across Mumbai, they are ready with all the required dosage of medicines as well as wards. And all the doctors have been informed to stay on alert. As soon as a rise is seen in these cases, they will be given immediate treatment. And also, it has been stated by the State Health Department, ensuring along with compliance with the BMC that there is no such untoward incident, especially when it comes to lack of careness being given to the patients of COVID. At this point, it is we see that there was a situation of panic amongst Mumbaikars when 2 deaths were reported. However, the BMC and KEM hospital to clarify that it was not because of COVID, and especially because Mumbai has an international airport. Travelers and passengers from across the world, they visit Mumbai, and because of which the chances of the pandemic being spread are much, much higher. However, at this point, COVID-19 is an endemic and not a pandemic, and it is at a stage where majority of people can face it. However, it is curable through taking proper precautions, and also people have been advised to maintain safe distance from people, especially at crowded places, to wear masks and take care of themselves and ensure that they are not in touch with at these crowded places with people in unhygienic conditions. And henceforth, once again, BMC preps up for the COVID-19 rising cases in Mumbai and also assures its people that there is no situation of tense or panic, especially when it comes to this disease, as the BMC and the State Health Department are fully prepared.
And that's all the time we had on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome. You're watching KYC. I'm Harsh Saita. We'll quickly look at the company that we're going to talk about. That's going to be Tips Music. Why are we looking at this company? Because it's super duper interesting. It's around 8,000 crore in market cap, but it has an asset base of just 300 crore. That's one of the reasons. The other reason is it has a very high free cash flow that it distributes straight to shareholders. So again, that's the other piece that you want to keep in mind. But one, what are they changing in terms of strategy? There is going to be a large change. The number of songs that they produce annually is going to go down by 70%. Yes, you heard that right. And there is a reason for that change. Now my question is to the management is going to be as to whether that large change is actually warranted or not, and whether that rationale is punchy enough for that large change. So that's the first thing I want to know. The second one is what gives them confidence to guide for a 30% growth when the number of songs that they are producing is going to come down from 450 to nearly 125 at the very maximum. So despite that sharp fall in the number of songs that they're going to produce, what's giving them confidence to drive a 30% growth for the foreseeable future and not just for FY26? The third one is going to be the outlook on cost per song. Cost per song has gone up from 8 lakh rupees for production to 16 lakhs. And this is average cost per song. That's the math we've done basis the commentary that's come out at the end of Q4. So over the last year or so, we've seen costs rise very, very sharply. What's the outlook going forward? Given that there are these large changes when it comes to the number of songs, does the cost of song change as well? And therefore, what's the impact of that on margins? And therefore, are they confident of maintaining that 64% kind of margin number? Last couple of things that I want to know is what happens to the free cash flow that continues to come in. They've done large amounts of buyback. over the last few years. Does that continue? Do they continue to distribute the cash to shareholders? And last one, what's the aspiration from a 3 to 5 year period? So it all looks good, but if you're able to justify the rationale and you're able to take care of margins, what's in it for the next 3 to 5 year period and beyond? What is it that the company is looking to achieve? This and more. But let's first, as always, dive deeper into what exactly does Tips Music do. And I'm going to quickly pull out what it does. First, it was founded in 1988. It has around 11.5 crore subscribers on YouTube. It's basically a music production and thereafter streaming company. So it produces and distributes the music that is produced by them. They are into the acquisition and exploitation of music rights. So they have already a bouquet of music songs for which they have rights, and those rights, they have a library of around 30,000 odd songs, and those rights are thereafter distributed. They also have produced and released around 40 Hindi films over the last 2 decades or so. They also sell theatrical, satellite and various other rights to distributors and broadcasters. A lot of this currently is with regard to music. It's a debt-free company. It has around 271 crore of cash and investments. This is as per their investor presentation. I want to just highlight that because cash otherwise on the balance sheet is not as large. The company earns all its revenue from license fees. Something to keep in mind. 70 to 75% of its revenue is through digital platforms. Not surprising, given YouTube, Spotify, the advent of digital is what the company has capitalized on, and the remaining 20 to 30% odd comes from other digital platforms. You have 45 to 50%, and those other digital platforms are platforms like a Zoom TV, right? So you have TV channels which broadcast music as well. So those are also some other means in which they make money. But 45 to 50% of the digital revenue, so to kind of break this down, 70 to 75% of total revenue comes from digital. 45 to 50% of the digital revenue comes from YouTube. So you have around 35% of the top line coming straight from YouTube. The export of services is a large chunk of their revenue. The domestic, not as much, because most of these streaming services are all sitting in the US. They're platform companies. Now, in terms of digital versus non-digital, that's the breakup, 75 versus 25. So non-digital now commanding a smaller share and will continue to come down, mind you. Let's talk about partners that they have and they distribute through. And these are just illustrative because there'll be several more partners as well. You have YouTube, Meta, Spotify, and Apple Music among the plethora of other partners that they have. This is in terms of the new songs that they added every year. FY22 saw 276 songs, FY23 896, FY24 733. Here's where things start to change. You look at the degrowth, 18% in FY24, 40% in FY25, and a likely 70% lower from that point in FY26. So you will want to watch out for this number as to why this is falling, and we will talk a little bit about that with the management. Let's also talk about the YouTube views which are being clocked, especially over the last few quarters. You look at the way in which the YouTube views are shaping up, and this obviously depends on number of days as well. But broadly, you have 5 crore plus views, around 6,200 crore plus views that, or 5,000 crore plus views that it clocks nearly every single quarter. And that obviously has an effect on the top line of the company. So that's how it's shaped up. Now let's quickly look at the metrics that we look for with regard to this one. We'll first look at the income statement. We'll thereafter look at the balance sheet, the cash flow. We'll look at shareholding. We will look at return ratios. we will look at street cred, we look at valuations, and we look at analyst recommendations. We look at all of these and try and assess as to whether this is a good business or not to possibly consider. Let's start off with the income statement. And if you look at the income statement, at least over the last 3 years, it's very healthy growth that you're seeing. Top line has gone up from 140 odd crore to 311 crore, which is a 32% growth. EBITDA has gone up from 86 odd crore to 210 crore, which is again a 30% growth. Margins have expanded a wee bit, which has allowed profitability to go up by 37%. It's difficult to give a business like this with a past performance, 3-year performance like this, anything but a thumbs up. So we've given it exactly that. It's as good as it can get. One thing that you should know with regard to how the numbers have shaped up, they largely spend their expenses, which is before EBITDA. All their expenses are largely on creating music, creating content, and they actually expense that out immediately. So say for example, they are creating a song in Q4 of FY25. They will expense that entire amount in Q4 of FY25, but the revenue largely from digital means will come for maybe the next 1 year, sometimes if lucky over the next 5 years as well. So therefore you'll have recurring revenue over the next 5 years, but your expenses are realized upfront. And therefore you're seeing the kind of margin number that you're seeing, because the expenses for a song which was launched 3 years ago were already booked 3 years ago. And therefore that income continues to flow to the top line. As the income continues to flow to the top line, you have margins which are holding up very well. But you might have some expenses in a quarter or two which may be elevated because you will be producing more songs in a particular quarter than another quarter. And therefore you might see some bit of choppiness on a sequential basis with regard to margins. But overall, when you're looking at the annual trend, you're seeing margins between that 60 to 67% kind of bracket. More so in an even tighter range between 63 and 67%. So that's something you want to keep in mind, that you don't want to look at this business from a quarterly perspective. You want to look at it from an annual perspective, whether they are able to achieve the annual numbers that they have been looking to achieve. So that's something you want to take care of. Now let's talk about the balance sheet. So income statement behind us, the balance sheet, its net worth is roughly 210 odd crore. Its net worth will continue to rise, but it's doing buybacks on a regular basis. It's a cash-rich company, mind you. They did mention in their PPT that they have 271 crore of cash plus investments. Now, when you're looking at cash on a standalone basis, you can see the number on your screen, around 40 odd crore of cash. They had 131 crore of cash at the end of FY24 as well, which they've used for some buyback as well in April of 2024. So something again to keep in mind is that they regularly distribute the cash that they have. They don't hold on to cash for a very long time. They hold on to cash only to produce new music over the next quarter or two. So that is something again that you want to take care of. The second thing is there's no debt on the balance sheet. It's a clean balance sheet. The asset base is extremely small. We spoke about that. It's just about a 300 crore asset base in terms of total assets. And last off, they regularly buy back shares. So your equity, your absolute equity base has continued to shrink. In terms of when I'm removing reserves and surplus from that equity line, just the equity base is shrinking on a consistent basis. Over the last maybe 10 years or so, we've seen a shrink on that number. Something again to look out for, that the equity base is shrinking. So that's with regard to the balance sheet. It's a thumbs up because there's very little to nothing to complain about in terms of either debt or in terms of cash. There's sufficient of all of those factors. Let's talk last about cash flow now. Cash flows are largely in line with profitability. There was a chunky amount in FY24 which came through, due to which there was a little bit of excess cash flow which came through in FY24. FY25, that has normalized. Largely, it's a steady state in terms of the cash flow. Nothing to complain about. In terms of cash balances, they keep smaller balances. I did speak about that. Also, they have a high payout to shareholders. So they largely pay out all of their profit to shareholders. Let's now talk about return ratios. In terms of return ratios, the asset base is very small, and hence the return ratios that you are seeing on your screen extremely high. I want to also highlight that this is one of the highest return ratios that you will see. But it's that type of industry where if you're expensing out immediately and you're not capitalizing any of your costs with regard to music made, your return ratios will tend to be higher. I want to highlight FY21, the ROCE was 47%, FY22, 62%, FY23, 62%, FY24, 79%. That's how the return ratios have gone. ROE is also 48, 63 in FY22, 64 in FY23, 81 in FY24 and 86 in FY25. So you're seeing a gradual inch up with regard to ROEs as well, but expect that to happen because you've expensed out a large part of whatever you've built in terms of IP, and the unwind of that is happening in subsequent years, and therefore that explains the ROCE and ROE metrics, but it's a strong number and hence the thumbs up. Now I want to talk about shareholding for a bit. Promoter holding 62% odd, 64% odd. No concerns with regard to that, and therefore we won't delve into this too much, but a clear thumbs up with regard to promoter holding as well and shareholding as well. There's plenty of skin in the game. Let's talk now about street cred. The last 6 months, the stock has been under pressure. Year to date, the stock has been under pressure, but the 1 year returns on the counter is good at 49%, and the 5 year returns is very strong. We'll give this one a neutral. That's how we look at street cred. Now let's look at valuations. Now when you're looking at valuations, Tips Music trades at around 49 times. You have Saregama, which is the other competitor, which trades at 51 times. But you look at the 1 year forward of Tips, and this is where it starts to kind of stand out. While it's an expensive counter, 1 year forward, it's looking at 39 times. And when you're looking at maybe 2 years forward, it'll compress even further to sub 30 times because the growth clip is very fast. So valuations, there seems to be some comfort, but you want to see whether the new strategy is getting executed because currently it's sitting at 50 times. If the new strategy does not execute well, then you might not see such a fast compression in price to earnings. And hence we've given this a neutral because there's a bit of a question mark there. The last one is with regard to analyst recommendations. There are 5 buy calls, 1 hold call. There's only 6 analysts covering this, and hence we're cautious. We've given this a neutral on that count, but the return potential is 21%. In terms of multiple, this is trading at the lowest multiple in the last 12 months, 1 year forward, that we have seen this trade at. So at 39 times, the multiple is also the lowest, and hence you are seeing that upside that we are seeing. Let's quickly though go across to Kumar Taurani, who's the managing director at Tips Music, on what the strategy is and what he is looking at in terms of market share. Welcome, Mr. Taurani. It's good speaking with you. Let me first start off with why this change in strategy? Why go from 450 odd songs to do 100 to 125? What's the thought process behind this like?
No, we won't give out market share. On the contrary, we will increase our market share. See, when we make 500-600 songs, so our time is limited. It's distributed in all the songs. We have a team of around 10 people. So if you calculate, one person is making 50 songs a year average, I'm talking just an example, a number, and 50-60 songs versus 10 songs he has to make. So I think he will be more focused and give me more quality, and we can reject more songs. And we are not compromising on the quality and on the money also. Whatever money we have planned to invest, we will invest that money. We will sign bigger artists. We will do bigger marketing. All that we will do. So that is a focus for coming years.
Got it. So that's for FY26. What about beyond FY26? Will you go for a larger base in terms of songs beyond?
Please understand that our focus is on a quality. So maybe 80 we karenge, yeah, maybe we can go up to 150 also. That's not a hard and fast rule. Okay, we have to just stick to a number. Whatever good quality songs we will get, and we have a budget, we will invest and we will acquire or produce. I think the way FY26 is behaving, I think more or less we are already there. And I think this year, okay, maybe last year some songs left out, maybe it will touch that number. But around 125, 150, yeah, this year.
And sir, the total market in terms of how India is shaping up is going to grow from around 7,000 to 10,000. So despite that, you will stand out and you will continue to do 100 to 125. So the number of songs is not going to be the focus at all.
I think we must realize what is the success number. I think if you see, our main focus is on a film side. So if India produces 1,000 films, the success ratio is only 8-10%. So our focus is we should be in that space maximum. And if you see my tips ka track record from 2005, 4-5 onwards, 90s we were a very aggressive player. We were the 60, 65, 70% of that period's content tips has acquired. And if you see at that time, from 88 till 2002-3, anywhere, any award function or any award, out of 10 songs, 7-8 songs, of top 10 songs, 7-8 songs belong to tips. And among the 5 nominations in many awards, we had 3-4 nominations. So we want to, after that, when market changed to physical to non-physical, so we concentrated on maybe 30-40 songs a year, but my success ratio is 90%. So that is the key to the music business, I feel. And touchwood, we have a very experienced team, so I think we can make it. And that is the next growth for us as well. So I think our focus is there. Plus, one more thing, nobody understands that music business, repertoire catalog is very, very important. If we all combine entire industry produce good new numbers, then our new numbers business will be 20-25%. But still 75-80% will be a catalog business. Whatever your favorite songs over the years you have selected, you have separated, you have made your own playlist, you won't forget listening those. In case you like 2 more songs, you will add to your playlist. But you keep listening all those songs over the years you have liked. So, and whenever there's no good new releases, so there will be a 95% of a catalog business. Only 5% will be new releases. So majority is catalog, and our catalog is touchwood doing very, very, very well. If you see, there is no major new releases we have done for last 4 or 5 years, and we are growing 30% year on year. So that is because of our old repertoire, whatever hard work we have put in last many years, that is actually giving us fruits.
Right. No, sir, I fully appreciate what you're saying. So, but you've also guided for a 30% growth. Give us the breakup. How much of that comes from old songs versus how much will come from new? And will that 30% growth be sustainable?
I think so far our new releases, you can say 15% contribution and 85% comes from catalog. But our going forward, our target still is a 30% top line we have to do for next 2 years, at least 3 years. So among that also, we want new releases should be more. So now target is we should achieve 20-25% to new releases and 70-75% should be a catalog.
Very interesting. Now, sir, the other piece is with regard to costs. When I'm looking at, and I've done this math, the cost per song has doubled last year versus this year for you. Where do costs go in this new shift in strategy? Where do costs go?
Cost will continue to rise. Harsh, please understand, we can acquire a song from 50,000, say, like 7-8 crores also. So that is the range. So we can't actually pinpoint. If I'm taking a big blockbuster movie of a multi-star film or something, so I have to pay 25 crores, 30 crores, 40 crores. Pata nahi abhi kya ho raha hai. But there's a very tough market. But we are not in that rat race. But there is like that.
Point taken. And sir, therefore, where should margins be at? 85% is from old catalog, 15% from new. Costs will rise. Where do margins go?
My catalog is doing really, really well. So our margin and then that entire catalog, whatever we release, whatever music we make or acquire, we release that music, we write off that content cost in that same year. So that is a big advantage Tips has. Or this is not, we are not doing from now. We are doing this since beginning. If I carry forward for 4 years or 10 years, then I have to pay more tax and it will hurt my cash flow in those days. Those days there was a very cash flow was very tight, so we have to need money quickly. So we used to write off entire content cost same year. So that is from beginning we are following. Still we are following that.
Okay, so sir, therefore EBITDA and PAT should also grow at 30%.
EBITDA will maintain. And PAT also, we are trying we should be at 30% in the 30% range, 30% top line, 30% bottom line. We should achieve PAT. That is our target for this year, next year. Yes.
What about distribution? You're a low capex kind of business, and therefore, will you continue to distribute dividend?
We give it to our we declare dividends or whatever last year we made money. Last year, our PAT was 127 crores. We given 136 crores to our investor shareholders by way of buyback and dividends. So we keep continuing doing that. Big dividends.
Right. Sir, talk to us about what the aspiration is in the next 3 to 5 years. Your low capex intensive, your 30% growth on top line, bottom line. What's the aspiration in the next 3 to 5 years?
See, we are very focused on this business, music and films. We have both two separate companies, films companies separate, music companies separate. And we are very focused and we are really doing good. I feel we can really do good in film business as well. It will take little time. But I think our focus is to build these two businesses properly and keep growing. And if we don't want to do anything other than this. So very focused. We'll continue doing this.
Okay. And so what's the risk like therefore? It looks like a very low risk business. 85% of top line largely guaranteed. Is the distribution model a risk?
I don't feel there is any risk there because they also need a business. They are also having they are not paying us any. Earlier, they used to pay us upfront minimum guarantees, but now they are paying us from earnings. So they are also making money from us and they are getting content, you can say directly free, actually. Okay, they are sharing some money with us and on a streaming basis or a advertising or a subscription basis. But we are investing so heavily, so they understand that. So I don't feel anything about that. And this is happening for last so many years. And if you think this is the same practice they are doing internationally. So why you want to disturb a smooth business is going on? Nobody disturbs that, I feel.
Okay. Thank you so much, sir, for coming in and breaking this down for us. Very interesting, and wishing you all the very best for the next year or so on this new strategy and its implementation. But what we're going to do is we're going to quickly also look at the ratings that we've given, the KYC rating on this one. Such strong growth, definitely a thumbs up. Balance sheet, thumbs up. Cash flow, thumbs up. Return ratios, we've seen how return ratios have gone up because the asset base is so low. Shareholding is a thumbs up, 65% owned by the promoters. Street cred, there's been some bit of a hiccup with regard to returns over the last 6 months or so. But the last 12 months have been solid. Valuations, again, not looking cheap by any stretch. It's at 50 times. That's what its peer also trades at. But there's going to be a new strategy at play. Whether that valuation holds fair or not is a neutral on that count. and analyst recommendations. Just very few analysts covering this one. So we've given this a 6.5 on 8 on KYC, at least for the moment. So that's our KYC rating. With that, it's out of time on this edition of KYC. We hope you found this helpful. Very interesting business. At least that's how I found it. Stay tuned. More action on the other side. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims?
Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Now, when it comes to financial decisions, a lot of them are influenced, shall we say, by what other people do. What is your neighbor investing in? What is your best friend investing in? And when you meet somebody at a dinner party, for example, and they say, hey, what are you doing with your mutual fund investments? You should be investing in scheme A, B, and C. And invariably, those schemes are sectoral or thematic schemes that have done particularly well over the last 6 months. And you feel, what have you done? Why have you made the decisions that you've made? Well, we're here to tell you that you're not really in a very small minority. In fact, most people get their decisions wrong when it comes to investing in sectoral and thematic funds. And we'll talk about why that is. We'll also talk about how you should approach your investments into these schemes. Joining me today is Himanshu Kohli, the co-founder of Client Associates. Himanshu, thanks so much for joining me and for speaking to me about this very interesting topic. Now, I did send you a few questions in the run-up to this conversation, and the data that you've pulled up is quite eye-opening. In this entire realm of nearly 200 schemes, it turns out that not many of them have been able to beat their respective benchmark and the wider benchmark either.
Right, Alex. So I would say what you mentioned, it's a typical social conversation. Someone says, I have invested in a defense fund. It has done phenomenally well. I have invested in ABC fund. It has done very well. And next day you want to pick up your paper and just maybe invest over there. So you're chasing maybe certain themes, certain excitement which is happening. And I would say the simpler you keep it, the boring you keep it, it is better for you from a long-term point of view. So if you see the data, very few funds have actually beaten the respective benchmarks. Very few funds, active category, have been able to beat the broader category, which is BSE 500 as a benchmark. Now, we do not think it's the best thing for investors to just chase certain themes basis what their neighbor has told them or their friend has told them, or maybe what they have seen some excitement on some one of the news channels. It is very important to put your whole investment thesis into investment policy statement. How much should be the core portfolio? How much should be the satellite portfolio? And if satellite portfolio is offering you one or two themes which you can just top up, what should be the best approach to go for it? Should it be through a pure passive index or should it be through an active manager over there? It's extremely important over there.
It's an important point that you raise. And what we'll do is we'll delve into some of the details. I think, Himanshu, the tendency also is to look at fund selection like you would look at an equity portfolio. And here, I think a lot of people, and this is data that proves it, most people venture into equity mutual fund schemes. And I know that that trend is shifting, thankfully so. People are looking at fixed income, people are looking at hybrid as well, which is a good sign. But the reality is that most investment takes place, retail investment takes place in the equity space. And people do select this basis how they would normally select a stock portfolio. Do you think that's the reason why you have a problem? And the fact is that we don't have a lot of history, a lot of expertise when it comes to selecting investments.
Right. So I would say a lot of people, they are chasing returns, chasing performances. In fact, the more detached you are with the portfolio, the better the performance is. So if you see from 1st of Jan till 15th of May, 4.5 months, there are 196 thematic funds which are there in the system. Only 14 of them have been able to outperform their respective index and the broader markets. Only 25% of them have been able to perform their respective index. Now, it is better to go to diversified mutual funds, or maybe if you want to add certain themes in your portfolio, it is better to go maybe through the index strategies. That is something which I would say is a better way to manage it. In fact, some of these hybrid funds, a lot of people said asset allocation should be in your hand. Why are you giving the discretion to the fund manager? In fact, if you see the data 3 years rolling, 5 years rolling, some of these asset allocation funds or balanced advantage funds or balanced funds, they have actually done far better because investors are detached from the investment decisions. There are no inefficiencies which comes into picture over there. And if they are particularly bullish, those fund managers are particularly bullish on certain themes, let's say banking, financial services, or defense per se, they can always overweight in a diversified fund towards those themes and give you that alpha creation if it's possible.
And the data that you've shared in the sectoral and thematic category, I just want to pull that up on the screen while we're at it, just to drive home the point before we go to Himanshu and ask him what he is advising at this stage and what he's seeing basis the trends that are currently prevailing. In the automotive space, for example, there is only one fund and it hasn't beaten the benchmark. PFSI, much more populated, but none have beaten the respective benchmark. Both benchmarks also not beaten. Consumption, there's one fund out of 18 that has managed to beat both the benchmarks. You have the most outperformance in the tech space, where you've seen 4 that have managed to beat their respective benchmarks, but they've not really managed to beat the broader market benchmark, which is the BSE 500 in this case. So it's not really looking like a pretty picture. But having said that, Himanshu, it's not like you don't recommend investing in sectoral thematic. You pointed out that there can be a tactical allocation. So if one is to look at this juncture, what the landscape looks like, how does it look like to you?
So Alex, we always believe in a core and satellite strategy. Core is 80% of the client's portfolio, which can be across large flexi oblique multi-cap, oblique mid and small cap, diversified funds, oblique certain indexes. Then there is a satellite. So let's say there is a theme which, let's say, banking and financial services is looking very good. So about a year back, 9 months back, we gave a call that we would like to add 10% over there. Now, there one can pick up one of these active managers or just the pure index over there and build the portfolio around it, because let's say if interest rates comes down or maybe the sector has not done very well in the past and today is available at a reasonable valuation, some of those things really bring alpha in clients' decisions. So this core and satellite approach really helps us. And sometimes we do not have anything in satellite, then maybe the 100% portfolio could be a core portfolio also.
Okay. I want to talk about some of these aspects because you've shared certain data. I was looking at the top performance and the bottom performance over the last 1 year for the sectoral thematic categories, and I was looking at some of the more popular themes and sectors, right? So things like IT or tech and things like infrastructure. And I found, Himanshu, that there is a very wide variance in the top performer and in the bottom performer. In certain cases, there is negative returns as well, whereas the top performer is gaining about 20% or 18% or thereabouts. Why is that? And talk about the way that these funds are curated and the portfolios are made.
Right. So let's say if we see some of the top performing themes have been defense, which has given about 28% returns in this year. I think a lot of it has happened because of this latest India-Pakistan tension. Defense stocks have done fairly well over here. But at the same point in time, they have become expensive. Now, financial services, as a broader theme, has done fairly well. It is also an outperformer right now because of the interest rates being low, the margins have been maintained, all those things. And it was not a top performing sector maybe 3 years before this. So this has actually come up quite well. And if you see some of these sectors which have not done very well is, let's say, pharma, for example, or IT, for example. A lot of it is dependent upon US also. Maybe there is some discretionary cut which is happening over there. So some of these things have actually not done very well. So if broader market, which is BSE 500, has given 2.5% returns. The range of certain themes could be anywhere between 28%, which is for defense, and minus 11-12% for IT, which has actually happened over here. So I would say these themes, they bring so much of excitement to people that I want to chase a particular theme because there is some major thing which is happening because of Mission Sindoor or something is happening in the technology side. For a retail investor, it's better to just stick to more diversified funds, even to maybe broader asset allocation or balanced advantages funds, because there the fund manager is actually taking a decision, and some of these retail investors do not have the ability to hire a professional wealth management firm to advise them on their asset allocation needs. So they can actually go to ready-made solutions over there. But yes, HNIs, UHNIs who can afford to have an advisor over there, there my advice is do not get carried away with certain sectors. Just keep maybe a smaller portion, which could be 10 to 20% to certain satellite themes, and then participate over there.
Okay, let's break it down though. And since you've mentioned defense a couple of times, I want to specifically ask you about that. There are a few more options that are available apart from the HDFC Defense Fund in the passive category as well. But considering the kind of run-up that you've seen in the defense pack as a whole, 20% plus last week, maybe some cool-off is seen this week. But would you take money off the table, tactically speaking, right now, if someone was to come to you, Himanshu, and say, look, I had this, I've been doing an SIP over the course of the last several months, and it's given me, 55%, shall we say, over the course of the last 1 year. And of course, that is point to point. You would probably have gotten more basis your SIP. Would you take money off the table?
Well, I will also take into consideration what is the capital gains tax which will be applicable, because if I'm paying short-term capital gains, it's also an added cost to me.
Yeah.
Is there any exit load which is applicable in case I take it out? I need to give weightage to those things because that's an actual cost which I'm paying over there. Ideally, I would like to be in the long-term capital gains tax regime, and I would like to be off the exit load period. Then it makes sense because clearly the valuations today in this sector are looking expensive. And since I have made very good returns, and if there is no adverse penalty I need to pay, maybe I would like to rebalance it over there.
But if the first 2 points that you raised in terms of short-term capital gains and exit load are not ticked, then you would say that incremental investments into the space might be stopped and you can hold. Is that a valid approach?
Absolutely. So in case there is an exit load as well as a short-term capital gains, I would like to hold on to whatever I have invested over there, provided I'm not overexposed to this one particular sector, which in most of the cases will be the case. And fresh investments, I will recommend not to go in for this because already the sector has run up quite a bit. And today it's an expensive sector to buy.
Okay. Just on the point of exit loads, you pointed that out, and for most people would know about this, but for the few of you that are coming across the theme for the first time, what happens is that a few fund houses actually put a load on selling of the units in a mutual fund scheme, and this is to incentivize you or to stay longer, rather disincentivize you from selling too early. Himanshu, is that a fair assessment?
I would say there are merits and demerits. Merit is if someone is coming in a scheme, they need to have a certain minimum time horizon. Because otherwise, if there is no exit or entry load, people can become more traders. So the whole thought of lock-ins or having an exit penalty is you come in as an investor, which is with a certain long-term view over there. While, yes, if there is a penalty, maybe the fund house makes more money at the cost of the investor. So that's a disadvantage to the investor. But to me, it sounds more like protecting the interest of the investor and getting the right kind of an investor with the right kind of a time frame to come into those schemes.
Yeah, and there are some very prominent names that have a pretty long a period for which they choose to have an exit load, and you know, the likes of the largest mutual fund scheme in India also has a pretty long period. But let's talk about a few of these other themes, Himanshu, and if you were talking about tactical allocations, and you mentioned banking and financial services, I do want to ask you about that specifically, because the way that I see it, most diversified funds, or even something like a Nifty 50, Nifty Next 50, would have a sizable allocation to banking and financial services just purely by dint of the fact that these companies have a pretty large weightage. So why would you want to go and have a further satellite allocation?
Right. So let's say if an index gives me 30% exposure towards these, and today I feel this sector is slightly undervalued with maybe attractive valuations. And if let's say FPI inflow starts coming in, which has just started happening also, and with interest rates the way they are, and there could be a likely rate cuts which could happen. Now, maybe the sector, I'm expecting it to outperform. So then I would rather be maybe 35 to 40% rather than 30%, which let's say a diversified fund is giving it to me. So I want to be overweight over there. And one of the ways over there is, since if I'm positive over there, to take maybe a particular sectoral call over there and go for a pure sectoral fund over there or an index over there. Because there are certain tailwinds which are fairly strong over there in this particular sector. So idea is always how much you want to be over and above what the benchmarks are offering you. And if you want to, you're bullish on a sector, there is actually no other way other than to go for a pure sectoral fund.
Okay. I want to delve into each of the sectors that I've selected. And I've selected pretty much the biggest sectors where there's most population of schemes. Consumption is the next one I want to talk to you about, because everyone's talked about consumption over the last few months, not FMCG, but consumption. And from that perspective, a lot of people have also started investing in this, thinking that at some point there's going to be this whole bonanza in the way of the income tax breaks that will come through April onwards, and these companies will start reporting better numbers. There's going to be returns through the roof. How have you looked at it, and are you advising your clients to look at consumption theme?
So consumption is actually a big theme in India, because almost 85 to 90% we are dependent on Indian consumption. We are not too much into exports. So consumption is going to do fairly well from a long-term point of view. And right now, I feel the valuations are fair over there. If one has to go over there, maybe go through diversified funds and let the fund manager decide how much they want to put in the consumption and which category of consumption they want to put in over there. So I'm not advising any particular sectoral fund over there right now because it's not, I have a long-term positive view, but valuations are also fair. It's not undervalued over there.
Okay, so that consumption out of the way. Infrastructure. And here, Himanshu, I think a lot of people are positive because of the growth story in India. And ultimately, for India to grow, power infrastructure has to grow. But the reality is that you've seen significant underperformance by a few schemes in this category as well. How would you approach this, and would you advise looking at this tactically?
So I would say we are quite bullish on India, and infrastructure is something which will actually lead to India growth story over a long period of time. So if we see all the data, the road construction, the railways which is happening, infrastructure which is getting built up in the country, whether it is power, next few years, there will be a lot of action over here. So I would say, yes, I'm extremely bullish on infrastructure. Only thing is, going through infrastructure fund per se, if I want to pick up, let's say, 5 stocks over there, and because of a particular sectoral fund or because of a particular index which I choose, I get 40 companies over there. Maybe 5 of them I'm very bullish on, but 20 of them I'm average, and maybe 15 just come in as a baggage over there. So there I'm saying, unless you have the ability to pick up those 5 stocks, do it yourself, or maybe just go to a fund which may want to emphasize slightly more on infrastructure, but not a pure sectoral fund. That would be a right approach over there, because I do not want to get the baggage of 15 stocks which will come as a part of my pure infrastructure fund. I would like to just see if the fund manager can pick up the winners, or I have the ability through my own office to pick up the winners, pick up those stocks and hold on to it for a long-term period of time. So short-term tactical call, no. Long-term, I'm very, very bullish. Fundamentally, infrastructure is going to do very well in India.
Okay. Himanshu, there are few schemes in this category that are very old. And I'm not asking you to necessarily recommend any, but I'm sure that you've studied the portfolios. For example, DSP India Tiger. And right. I looked at the last 1 year performance, and I've looked at the fact that it's down 0.84%. But since inception, it's 17.7% CAGR, and it's significantly beaten the benchmark, right? So what explains the underperformance? You have Tata Infra also that is relatively underperformed. Quant Infra is underperformed. Whereas on the other end, you have an outperformance by something like an LIC Infra, which is a positive 8.8. So there's a pretty big divergence here.
Right. So it also depends on which stocks they have selected, how much overweight they have gone on a particular stock. So if you ask me, there will be always a short-term divergence, but long-term they should actually move more towards the mean part of it. But over here, Alex, I would say infrastructure Tiger Fund, for example, has given phenomenally good returns over last 20 years. Over last 20 years, it has done fairly well. But last 1 year, the theme of value has come down. Growth has actually picked up over here. And some of these value stocks have not done very well in the recent past. But if I just take out last 6 to 12 months and before that, 3 years previous to this, value was doing very well. And that's where infrastructure or some of the PSUs, they were actually outperforming a lot. But a time for growth has actually come in for last 8-9 months. And that is where maybe you have seen a negative return in some of these infrastructure oblique value themes in the last few months or so.
Okay, let's round off the list and talk about pharma, healthcare and technology. And would you advise getting in tactically to any one of these, considering the kind of news flow that is coming in from the United States, and that's having a bearing on these practically on a daily basis, Himanshu?
Right. So very interesting point, Alex. Now, something which is not doing very well and has fallen, typically the tendency is to move away from there. I would say IT and pharma, healthcare, they are great long-term themes. And if it has fallen, maybe it's the time to become slightly greedy over there. And yes, there could be more news flows which could come. There could be higher volatility in these sectors as we see. maybe if someone has to pick up, where valuations may suggest that you pick it up, but maybe go in a systematic manner. Don't buy it on day one. Maybe spread it over next 3 to 12 months, depending on your profile, whether you're aggressive, moderate, or conservative.
Okay. Now, to bring this conversation home, just a point. You've spoken about satellite allocation of 10 to 20%. Now, how would you approach this? Because you see opportunities in sectors in particular. It's like you have stocks. When you have dry gunpowder, you will deploy at once. So there is a lump sum investment, and you've pointed out in certain sectors you can stagger your investments. Is an SIP approach appropriate here, or would you tactically shift out of certain things and shift into a sectoral thematic fund?
So let's say 80% is more like a core portfolio.
Yes.
There, Alex, we believe one should just enter and hold on to it for about, let's say, 5 years, because equity is actually a 5-year kind of a time horizon is required. Even if exit load moves away after 1 year, your long-term capital gain tax kicks in after 1 year, but you hold on to your core portfolio with a 5-year view. Satellite portfolio could be with a 1 to 2 years view, minimum 1 year because of the taxation and loads which are applicable up to 1 year, adverse taxation and loads which are applicable up to 1 year. So there I would say certain themes where I am seeing certain volatility. Let's say I mentioned to you about IT or healthcare because of tariffs or because of whatever is happening in the US right now. A lot of it is happening. Volatility is happening because of that. It's likely to continue for some more time. So there it's more prudent to do systematic investment plan, SIPs. Now, I know there could be an opportunity today, but I want to reduce the risk also, because everyone focus on one R, which is return, but second R, which is risk, is equally important or even more important. There, I would say if someone is extremely bullish, maybe do a shorter term, 3 months SIP, but don't go lump sum over there. Also, when you have to move this, you have to see from where you can pull it out. Is it fresh savings which you are getting from your monthly salaries? Maybe use that. If not, maybe some money is lying in liquid funds, use that. Or maybe some places where you have actually completed a 5 years period and there is a reasonable returns over there, and you want to take advantage, maybe redeem that and invest over here.
Okay. Himanshu, the last point, and I'm not pushing you to make recommendations, but we've spoken about BFSI, we've spoken about healthcare, and we've spoken about IT. And these are 3 themes that you seem to like at this juncture based on everything that is happening. Specifically, from the list of schemes that are available, what schemes, according to you, are well run and that have a good track record that my viewers can look at closely?
So I would say, Alex, rather than recommending you any particular schemes,
yes,
I will say there are certain fund houses which are very well run. Whether it is HDFC, whether it is ICI, whether it is Nippon, some of these fund houses, they are run very, very well. If you are going in for the thematic schemes, I would emphasize that maybe go for the index funds over there. Or maybe if you are to still want to go for an active manager in these themes, pick up from one of these good houses where you are very sure about the long-term duration, maybe the governance systems, credibility has been established. So I would recommend maybe going for good houses. Again, as the data I have shared with you, I see a lot of merit in going through pure index funds rather than active managers for these thematic schemes.
Yeah, very, very well put, because active managers have failed to beat the benchmark over a period of time. Himanshu, thanks so much for joining me today. Pleasure having you on the show.
Thank you so much. Thank you, Alex.
All right, that brings us to the end of this edition of Your Money Matters. It's possible that you're left with a few questions after this conversation that we've had, even though it's been pretty detailed. But I'd invite you to write to us in the comment section and let us know what you'd like to know about, and we'll take it up in future shows. Thanks so much for watching. This is NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims?
Right, a number of factors have stood out for Hyundai Motor India in its Q4, and several factors have aided that bottom line outperformance. Among them, the mix as well as the average selling price and the lower discounting in a pretty tough operating environment. I'm joined by Tarun Garg, who's the COO of Hyundai Motor India, to talk about the quarter gone by and to talk about the outlook going forward. Mr. Garg, thanks so much for taking the time. Let me start by asking about that volume picture. Understandably, for yourself as well as the industry, it's been a little bit of a sluggish period. Do you see that changing in FY26? What is the anticipation for volume growth for you?
Thank you. Actually, if you see, India is one market where the car industry has been steadily growing, over the past, of course, 30 years. I have been in the market now for 31 years. After every 5 years, there is always 1 year where the growth is muted, sometimes negative. I don't think it should really disturb us, because post-COVID, we also all saw that market had grown by more than 20%, and again, almost 10%. So obviously some kind of a demand moderation had to happen. On top of it, a car customer does not like uncertainty with the tariff scenario and the geopolitical situation. Obviously that crept in. So I think this is very normal. Also, in any case, this period of April to August is a period where there is generally heat wave in the country. There are no festivals. So I think it's very normal. What we have to do is how to navigate this situation. You saw in our last quarter results how, despite sluggish market, we were able to keep our discounts low by introducing some new value trims for the customers, by making sure that the SUVization continues. Our SUV penetration, in fact, in the last fiscal touched now 68.5%. The rural penetration continues to go up. The first-time buyers continue to go up. Overall, we could get a EBITDA margin of 12.9% for the year, and and in fact 14.1% for the last quarter. So I think a good balance between volume and profit is what has helped Hyundai Motor India. Now we have a very aggressive product pipeline in place, and the Pune plant kicks in the third quarter of this fiscal.
Yeah.
So I think things are looking up.
So things are looking up, but then am I right in assuming that you will grow along with the industry, and what is that level of growth that you're anticipating in volume terms?
Look, if you talk about the next 5 years, obviously with the kind of model mix and the kind of new model launches, and of course the Pune plant capacity being added, because we are currently at 824, we will add 170,000 in phase 1, which is in October to December quarter, and then 80,000 in 28. So which will help us reach 1.1 million. So we are definitely looking at beating whatever the industry growth happens in the next 5 years. As far as this year is concerned, we have given a guidance of an export growth of 7 to 9%, and domestic, of course, like I said, probably in line with the industry. Siam is saying around 1%, so we should be broadly in line with that.
Okay. So thanks so much for giving me clarity on that. Would you say that with the addition of the new plant in the third quarter, overall, therefore, capacity utilization might be a little bit on the lower side overall in FY26, and that will of course pick up, Mr. Garg, over the course of the next 5 years, as you point out?
Look, Hyundai has always prided itself on having a very good capacity utilization. Over the past so many years, we have managed a capacity utilization of between 90 to 95%. One big reason for that has been, in addition to our very strong domestic presence, we have a very strong export portfolio. Currently, export constitutes about 20 to 21% of our sales. Going forward, we plan to take it up to 30% by fiscal 30. So I think while the new plant comes in, yes, initial period, obviously, it cannot reach 100% immediately. I mean, that is for everybody to know. But I think the kind of track record we have, we believe that, and the new model launches, we should be able to really reach a good number in a very short time. Exact month and exact numbers would be very difficult for me to give. But I don't think there is anything of very undue concern which is coming because of the Pune plant. On the contrary, I think it will be a turning point for Hyundai, like I said, because we have managed to marry our new model introduction with the capacity addition of the Pune plant.
Okay, talking about the market X, the ICE, so I'm talking about EV and I'm talking about CNG. In both of those, what is your opinion of the current playbook for your company? For example, can you give me a sense of what the current booking numbers are for the Creta EV, and what is your playbook in terms of CNG?
So look, as you know, Hyundai Motor India is a part of the Hyundai Motor Group, and the advantage we have is that we have all kinds of technologies. At the entry level, we are offering the customer petrol and CNG. At the SUV level, we are offering petrol, diesel, and now with the Creta electric as well. Of course, in the Varna segment, petrol and turbo. So we are very confident that this kind of technology agnostic approach will really help us to navigate the future challenges. On the EV space, Creta EV has had a very good response. We are selling more than 1,000 a month already, and I think going forward, the kind of model plan we have, like we said, 6 EV models by 2030 we are going to launch. Also, it is coupled with a very strong localization drive. So currently we have battery packs which have been localized. Now with the Indian partner, we are going to localize the cells as well. Also, we are doing a big thing on the DC fast charging infrastructure, because so far we are focusing on the AC fast charging AC charging infrastructure. But now we believe, based on the customer research, we have seen that customers are hesitant to take their cars on the highways. So we have taken it upon ourselves to a big time focus on that activity. Currently, the number of DC chargers, including the DC chargers on the dealerships, is already about 88, 89. We plan to take it up to 600 by 2032. Okay. So I think CNG is about 13 to 15% currently, going up consistently. EVs, we believe by 2030 we should be in the range of 15%. And of course, we have also announced the launch of hybrids in the future as well.
Understood. Okay, understood. Now, I want to specifically talk about what you mentioned in terms of the SUV increase, right? Of course, as a country, there has been this this move towards the SUV category, and as a result, the small car category has shrunk, Mr. Garg. And you've been witnessing this for 30 years, so you know exactly what I'm talking about. So, would you say that, considering that the pricing of the small car is now coming very close to that small SUV category, that this small car category will continue to shrink? And what is the implication for you and your portfolio?
Look, I would say that the customer's choices have changed because his key buying factors have changed. So it's not as if the price range like for example, in the price range of 6 lakhs to 10 lakh rupees, earlier there was nothing called an SUV so much. Then of course the venue segment opened up, and now the extra segment has really opened up. So it's not as if the customers are not buying the cars, say in the 6 to 7 lakh rupees range. Only they are shifting from hatches to SUVs. Why? Because they are getting a good body type, they're getting more space, they're getting 6 airbags as standard, they're getting more features. So I think as an Indian, I'm very happy because this shows that people are progressing. That said, hatches are still about 23% of the overall market. Indian market is 4.3 million. That means hatches are still constituting about 1 million. We are very much there with i10 Neos as well as with i20. So I think we are a full range manufacturer. We need to give new solutions to the customer. For example, the dual cylinder CNG in Neos and Exter has really taken the CNG penetration up. And like I said, Exter has been launched. Going forward, maybe some new segments will open up. What is the most important thing is whether the first-time buyer is coming to you or not. I think that is where Hyundai has been able to shift the first-time buyer from hatches to SUVs. And my overall portfolio first-time buyer has gone up from about 34-35% 5 years back to about 40% now. So I think there's no need to worry. And I'm very happy that we are progressing as a country.
Yeah, interesting. And I think that is what has had a bearing on your operating performance as well, that mix, what you're talking about, right? But speaking about segments, and you're saying that a few segments might open up, Mr. Garg, but can you give me a sense? You have a pretty wide bouquet of products, but do you see any gaps that you need to fill? You said that you have a very extensive pipeline. Can you give me a sense of what gaps you're intending to fill?
Look, obviously new segments are always emerging. I already mentioned about Exter. A few years back, even Creta was a new segment. In 2015, when we launched the Creta, SUV penetration was 13% of the overall market. Who would have thought that Creta will end up being the number one brand across all models? Last 2 months that has happened. So I will not be very specific here, but I would say that with full model change of the existing models, what happens is they become more bigger. And that is where the new opportunities come. So we are very clearly identified some of those opportunities. More details, please wait for the Investor Day, which we have already announced in September, where we will be giving a detailed deep dive into our future models and the new segments that we are going to enter.
I look forward to that. Mr. Garg, my last question to you has to do with the margin profile. And you mentioned the various reasons why it has come in at what it did in the fourth quarter. You've given us the expectation for both exports as well as domestic. But there are a few factors that played out in your export mix as well, with Africa having a larger share. That had a bearing on the margins. So would you say that you would either maintain or better your margins in FY26?
Look, it is very difficult to give exact future guidance, on the margins. But what is more important is your volumes increasing? Are your, especially in the export area, we are really looking at new markets as well. Like, for example, venue in Indonesia, venue in Yemen. Going forward, we are going to have extra left-hand drive, which will open up some markets in the Latin American space. Already we launched the extra right-hand drive in South Africa. So EVs, we started with, Nepal, even Bhutan, where exports had been muted or banned, have opened up. So we are really looking at all kinds of markets, not only the neighboring markets, not only the Middle East and Africa, which have been very, very strongholds, Latin America. I think there are many opportunities to open up. A big factor here is, like I said, the capacity, because last few years probably capacity constraint, was making our export efforts a little bit muted. But now we are going full hog on exports, and we believe that going forward exports can contribute 30% to our overall volumes.
IRB Infra. Now, if we look at what has happened in their fourth quarter, they've reported a 4% of a revenue growth, but it's the profit which grew by 14% compared to the last quarter, and the toll revenue also saw about 17% of a jump. Now, the company does expect a lower double-digit growth in FY26 in their toll collection, but to talk to us about all the developments that are happening and the growth expectations for FY26, we are joined in by Anil Yadav, the Director, Investor Relations of the company. So, firstly, welcome to the show, Mr. Yadav. I would like to start off with the Q4 numbers. Your assessment of the overall quarter, how have they shaped up? We are looking at a 4% of a revenue growth, but it's the margins wherein we are seeing higher expansion this quarter. So talk to us about these headline numbers.
Yeah, I think thanks for having me here. With respect to the Q4, we have witnessed healthy revenue growth. In fact, if you look at the full financial year, we have our revenue growth was around 23% as against India's overall toll collection, which grew around 12.5%. So we have seen a robust growth as far as toll collection is concerned. And in terms of the quarter gone by, we have witnessed a 17% toll growth. And for next financial year, because in FY25 we started a couple of TOT projects where the toll collection was better than our estimate. And in FY26 we are not adding any new asset per se. With the existing asset, our revenue is expected to grow between 10 to 13%. We have witnessed 10% growth in the month of April. It's a like-to-like, roughly 3.5% kind of tariff revision and plus the traffic growth. We have a couple of projects where we're tolling for one project, which is 4 to 6 laning project. There, the tolling from 75%, it will become 100% and plus 3 years inflation. So there, the tolling will increase, and plus Ganga Expressway project, we are expecting to start by second half of this financial year. So we are expecting growth on that count. So we expect around 10 to 13% kind of growth on toll revenue and similar kind of growth on the PAT as well.
So 10 to 13% is the growth that you're expecting in the toll revenue is what you're saying. Now this, if compared to, FY25, we've seen about a 23% of growth. Isn't this on the lower side that we are looking at this number, considering that in FY25 we did have a couple of setbacks also related to elections and other factors, muted orders. So just want to get your perspective on that.
I think in FY25, there was an impact of two projects which started from 1st of April 25 itself. So the base revenue didn't had those two projects, so that's why the growth is higher. Even the Hyderabad project also started during the financial year. So there was also impact of this three project on the FY25 revenue. Now in FY20, those base are already improved. From the improved base, we are expecting around 10 to 13% growth. Here, we are not factoring any new toll road addition in the current financial year. If we add more projects, then definitely growth will be much better what we are discussing today.
Okay, so that's the perspective that we are seeing in terms of where the toll revenue growth is concerned. Now, coming to your order book, just want to understand the overall picture in terms of the current order book, which is there roughly at the size of 30,000 crore is what we are looking at. What's the kind of execution that we are supposed to see for FY26? New order inflows also, if you can give a color on all these three aspects.
I think the order book is in excess of 30,000 crores, and large portion of the order book is O&M order book. We expect out of this order book around 3,500 to 4,000 crores kind of execution in FY26. But if you look at IRB, the 85% value comes from the asset business. And if you look at IRB private InvIT, where we are planning to transfer the three assets to the public InvIT, and the EV what we are transferring is around 8,500 crores and expected to realize equity value of roughly 4,800 to 5,000 crores. With 5,000 crores of equity realization, typically the BOT and TOT gets funded 70-30 debt equity. We can bag another project of roughly 15,000 with 5,000 crores kind of equity, which is getting released from the sale of their three assets. and there is enough pipeline available. I think almost 600 billion worth of TOT opportunity, that is 60,000 crores of TOT opportunity available for bidding, and there is almost 450 billion, approximately 45,000 crores of BOT pipeline is also there. As and when those projects will come for the bidding, we will be participating for those bids.
Right. Anil, good afternoon. This is Hiral on this side, and happy to speak to you as well. Firstly, you mentioned about the bid pipeline with regards to BOT as well as the TOT, which is the toll operate transfer projects which are underway. Now, one aspect is the pipeline looks pretty strong, but the kind of competition which is coming in is also pretty intense. Taking that into consideration, what's the realistic picture that you see that could translate into an order book for your company?
Yeah, that's a very good question. And in terms of, as you rightly mentioned, we have seen intense competition in EPC and HAM. And you might have noticed that project is going 40-45% below NHAI TPC as well. And this is the project which is getting awarded on EPC and HAM. If you look at historically also, we are not bidding for EPC, very selective on HAM, and going forward also we will be focusing on TOT and BOT. And if you look at the TOT and BOT which got awarded in last 2 to 3 years, we have not seen more than 3 to 4 players coming and bidding for the TOT and BOT. So I think there will be some competition in BOT and TOT, but not that intense competition which we see EPC and HAM, because BOT and TOT are capital intensive project, and where typically we are competing with the funds and not the EPC guys.
So tell me one thing, Anil, from historic performance, if you have a bid pipeline of say your 100% is 10,000 and the conversion rate is say 50%, currently taking competition into consideration, whatever the number be, what according to you are you baking in terms of conversions?
Yeah. So in terms of, if you look at our asset base, we have asset base of 80,000 crores. Our aim is to reach an asset base of 1,40,000 crores in next 3 years. So we are talking about roughly 15 to 20,000 crores kind of order accretion in terms of BOT and TOT.
Okay, Amit, you mentioned about, there being pressure with EPC and HAM projects wherein because of intense competition, there's a bit of pressure in terms of margins also. So taking all that in perspective, if you have to see a sustainable margin profile going forward for the business, what are the kind of margins that should be expected?
So I think as far as company is concerned, EPC is only complements the asset business. We don't do any kind of third party EPC. We are doing the EPC for IRB assets and EPC and O&M for the public and private InvIT as well. So considering that, I think we should be able to maintain the margin what we are reporting so far. And in terms of the market share for TOT, it's almost 33% market share for the TOT projects.
Okay, so that's in terms of the margins that we are looking at. Now, in terms of, you have talked about the strategy to monetize assets from private InvIT to public InvIT. Just want to get your overall perspective for FY26. What is the kind of outlook or strategy that you have in this? There's been an increasing focus towards this area that we have been seeing, right?
Yeah, so IRB has devised one policy which we coined as BEST, that is the best. B means bid, execute, stabilize and transfer. So we are bidding the project. We are executing those projects through a private InvIT. Once the asset is stabilized, we will transfer it to the public InvIT. And we will unlock the capital and again use that capital for the future bidding. For example, private InvIT is bidding with an equity IRR of 14 to 15% and transfer those assets to at 12.5% to the public InvIT. Again, use that capital for bid the future opportunity. So that is the stated objective and strategy for the company, and we are going to implement the same.
Okay. Anil, in terms of the capex plan and the outlay that the government has in terms of FY26, the growth number that we've seen so far, do you see that incrementally flowing in, right now in terms of business, or are you seeing a disconnect there?
I think the government has a robust plan. If you look at last 1 decade, the large infrastructure spending was done by the government itself. And now the government wants to monetize those assets, and government pushes basically to do the most of the project on the PPP basis. So that will consist of BOT, TOT, and also certain strategic importance assets will be on a EPC and HAM. So I think if the award activity will start, I think there is a robust order book. But having said that, because of the last year was first half was impacted because of election. In the second half also there was lower activity as compared to the previous years. And if you look at, we are in this sector from last 3 decades. And historically also we have seen 1.5 years lull in terms of awarding, and thereafter the awarding activity again starts. So I think going forward, the kind of opportunity which government has showcased, I think there will be enough opportunity coming our way, and as and when the bidding will start, we will participate for the same.
So that's the outlook so far. But, Anil, the key over here is from an investor perspective that the stock has been seeing cuts of almost 25 to 30% in the last 1 year. Anything that you have in terms of investors as to where is the improvement going to come from, specifically taking into consideration the return ratios?
So I think if you look at with the existing business, as I was talking about, with the existing business, we will be growing 10 to 12% in terms of the bottom line is concerned. And if we'll back the more product, there will be further improvement in terms of the profitability is concerned. I think on price, if you look at the price, it was not largely driven by the business. I think overall sentiment in the market, especially small cap and mid cap, was impacted in last 6 months. So there I don't foresee that people have a concern on the business. It's across the spectrum in the road sector, the award activity is low. And I think it's a temporary feature. And in long run, we will see the more project will be up for the bidding.
Right. Thank you, Anil, so much for speaking to us and the investors as well, clearly. So that's interesting. The bidding pipeline seems to be strong. Profitability is expected to improve, and from here on, there could be improvement going ahead as well. So that's with regards to IRB.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in?
Welcome. You're watching The Big Question with me, Tamanna Inamdar. What happens when the very people who are building the future get left behind? It may sound like a far-fetched situation, but with the way things are progressing, it's becoming more and more of a reality with each passing day. In a move that has shaken up the tech world, just a few days ago, Microsoft laid off 6,000 of its employees, a total of 3% of its global workforce, making it the company's biggest workforce reduction since 2023. Ironically, amongst the ones to be axed was one of Microsoft's own AI directors, proving that even leaders of artificial intelligence are not immune to the very revolution they've championed. In fact, Microsoft CEO Satya Nadella says AI now generates 20 to 30% of the company's code. This is not a standalone story. Companies across the board are handing out pink slips. Data from the layoff monitoring site layoffs.fyi reveals that more than 61,000 employees in the tech sector have already been let go in 2025, and we're not even halfway through the year. Just earlier this week, IBM said it has used AI to automate several HR functions, effectively replacing nearly 200 HR roles. The move comes amid reports that IBM is planning to lay off up to 9,000 employees across various locations in the US as part of a large-scale corporate restructuring. Google also trimmed its workforce, laying off 200 employees in Global Business Unit, which is responsible for sales and partnerships. Similarly, Amazon has also slashed 100 roles in its Devices and Service Unit, the team which oversees developments of products like Kindle, Echo, and Alexa.
Chegg, a US ed-tech platform, too said it would lay off about 22% of its workforce, or about 248 employees, to cut costs and streamline operations as students increasingly turn to AI-powered tools like ChatGPT over traditional ed-tech platforms. And imagine this list is just from May. The beginning of 2025 saw Meta slashing 5% of its workforce, 3,600 employees, and this is only the beginning perhaps for Meta. World Economic Forum's Future of Work report 2025 warns that 39% of existing skill sets will become outdated by 2030, while 40% employers anticipate reducing their workforce in roles where automation can take over. But here's the twist. AI is not always the efficiency solution it's made out to be. Take Swedish fintech company Klarna, for example. After replacing nearly 700 human workers with AI systems starting in 2022, the company has gone on a course reversal, admitting the results fell short. The tech didn't deliver what was promised, and now Klarna is rehiring humans to do the jobs machines couldn't. So it's a slippery slope in that sense, and hence we ask the big question today: is the AI threat to your job already here? Now, to speak more on this, I'm joined today by Dr. Ramanand, Director, Center of Policy Research and Governance, Ananya Batra, Founder and CEO of Listener AI, joining us on the show. I'm also speaking with Arsh Goyal. He's a software engineer and tech content creator. Shruti Swaroop joining us. She's founder of Embrace Consulting. Welcome to all of you, and thank you so much for your time with us here on the show today. We're trying to understand what this AI future looks like. We're not coming to the conclusion that it's a threat or it's not a threat, but we need to definitely understand what's happening. So Arsh, I'm going to start with you and ask you that simple question. We've been talking about this for a while, that AI is going to replace some very core jobs. Have we seen the first real signs of it this month alone?
So it's again a very debatable question. We have seen big tech companies, be it Nvidia's CEO Jensen saying that we don't need to learn programming. We have seen Meta's CEO telling about that they will be removing all the mid-size engineers, and a statement coming from Salesforce saying that they won't be hiring any software engineers this year. So it is a matter of threat to software engineers, as in their thought processes change a lot. When it comes to the situation this month, yes, companies have been doing restructuring as a part of cost cutting. Some part of this restructuring might be rewarded to AI being in practice. Plus, there are multiple other factors that companies are thinking of, and there are many new roles that are coming in when it comes to AI, so that people can build along those lines. People can make their workflows efficient using AI. And the scenario has been in this state from past 2 to 3 years. And specifically, if I'll tell you, the market of freshers is something that's the most hampered, or there's a lot of turmoil with a lot of engineering graduates passing out each year with low skill sets, and companies are not willing to hire those. So that's the situation right now.
You know, there's a NASSCOM estimate that you could see over 20%, 20 to 30% of jobs in India being replaced by artificial intelligence. I mean, this is already here. Ananya Batra, give us the real world view on how you are looking at hiring, how you are looking at the changes AI brings. And it seems like a no-brainer for any company, right? If you can get software or you can get AI to do the job instead of having to hire people, then it is more cost efficient.
Right. So see, just like you said, right, it's a double-edged sword. So internally, we have been, actively pursuing using AI tools for our entire engineering team. So things that could be done in, say, a week are now being done in like a day or two, right? So there is definitely an increase in efficiency. But see, again, when it comes to this firing news, right, it's more about firing the B and C players rather than the A players. So the A players are still there. They actually have increased their efficiency quite a lot, some even by 10x, right? So just by using these AI tools like Cursor or Windsurf or anything that comes to mind, right? As far as that is concerned, I think the B and C players will always be churned out. I think that's the case in any organization and any field, right? With that being said, back in the 1914, right, when Henry Ford was sort of building the assembly line, the people who built the assembly line were let go of a while after it was built, right? So, I mean, and a lot of new jobs were created as a consequence of that, and the world is a lot better, right? It's a better place because of that. So we can't argue that he shouldn't have built the assembly line and he shouldn't have fired those people, right? Because it did lead to
one minute. We've gone through a lot of thoughts together. Let's just break them down one by one, Ananay. You said that this will impact the B and C employees, not the A employees, correct?
Yeah.
Now, who's determining who's A, B, and C?
It's efficiency, right?
And what is the chance that a B cannot transition to an A and an A can't transition to a B at some point?
That definitely happens. So, Bs become As and As become Bs. In fact, there's a lesser chance of As becoming Bs than Bs becoming As, right?
Right.
But see, with that being said, a lot of the mediocre developers, even like say 6 to 7 or 10 developers, right? They've become really good because of these AI tools. They've actually learned quite a lot. Not by, just simply because Cursor and tools like Windsurf, right? They help you learn and also write a lot of the code, right? So that's not the case here. So I'd say it has a lot to do with agency itself. So if you're a developer who, wasn't that great in the pre-AI era and now is shipping code with 3 or 4x efficiency, right? You're still far ahead of a lot of the people, right? So yeah, I'd say it's a function of agency rather than anything else. Right? And as far as the A and B and C sort of distinction is concerned, it has everything to do with the output, right? So you can look at a person's output and you can force.
Sure. That's still you're in a position to do that. I mean, what really struck me with all of the developments in the last few days, and I'm going to come to you, Dr. Ramanand, was that the head of AI development has also lost his job to AI. I mean, by all stretch of the imagination, he would be in A category. Just going by the categories that have been listed out on this conversation right now. I don't know if you can win this fight by thinking, okay, I'll make sure I'm an A and not a B and C.
Tamanna, I will say I'm not going to enter this debate whether A will replace B or B replace A. I'm concerned more about, how much prepared we are for this, this transition. If we are, understanding this AI transition, just like, we have seen the BIM movement of 1990, then we are totally misreading all the script. It's not like that. AI, I think I will say, is a huge moment for the human, history, and we need to understand that. And not only we need to understand, but we need to prepare for this thing. Today we are talking about how some software companies have replaced or kind of fired some of its employees. But in last 1-2 years, we have seen this thing in banking sector, in a lot of publication houses, in media industry, in hospital industry, and everywhere it's changing. Whenever this happens, I usually think about it, and I usually ask simple question: whether as a community, as a society, we are getting prepared for AI transition, or we are just trying to kind of react on this issue.
No. So 1 second. This is an important point you've raised, Dr. Ramanand. Prepare how? How do you prepare to do something? And I'm coming back to what Ananay said. How do you prepare to do something in 2 days, which otherwise as a human takes you 10 days? Why am I talking about this ABC business? Because is it about skill, ability, and will, or is it just about technology doing something better than you do?
No, it's all about the idea. It's not only about the skills. I will say AI सिर्फ अभी 2 साल में नहीं आ गया. We are assuming it will come from last 5 years. So
Yeah.
how our academic institution, how our industry has responded to them. If we are still teaching in our colleges the traditional method, if you will learn this thing, you will get a job. So this traditional approach is not going to help us. If you are understanding as an industry, we need this kind of a workforce for certain period. That certain industry is going to fail, or certain company is going to fail. We need
Shruti Swaroop, your take on this. And what bothers me is, yes, some jobs will go, maybe there'll be some other enhancements, but that'll be different people, right? That same person who is doing something let's talk about the IBM case where people in human resources have been replaced. I mean, what are they going to go and do with AI now, which makes them hireable somewhere else? This doesn't seem like a battle that can be really won beyond a point.
Thank you, Tamanna. I was hearing the conversation that is happening. I think we need to divide it in few parts. Firstly, how much of layoff in percentage is happening because of AI and how much of it is happening because of business changes, world changes, the agility that one needs, because the world is continuously changing. So I think let's first, let's look at real numbers. We have numbers that say that 44% of job losses in 2024 were due to AI efficiency. But overall job losses percentage-wise are far more. So we need to understand that not every job loss can and will be because of AI. So that's one. Secondly, the roles which are going and we know for a fact which will go are the ones which can be easily replaced by AI. So clerical roles which don't need as much of value add. Research will always going to be there. Research, you cannot take research completely and convert it to something else. What are things that will always stay? So there are things like, for example, 3 years back, we used to think that design is going to be there. Today, design has been replaced by AI. But we know that the quality that is coming out of AI generated graphics is not at par with human generated ones. So we need to also understand that not everything can be replaced. Certain roles will continue to stay. We have to keep moving with the times, upskill ourselves so that we have basic understanding of AI, so that we can have intelligent conversations, so that we at least know how to humanize and ensure we are getting best quality out of AI. I think that is what we need to understand.
Shruti, my only issue with this is, so you're saying the research roles will not be replaced. Those in research listening to this right now might be thinking, okay, the clerical roles will be replaced, but then there are a lot of people doing clerical roles in terms of sheer numbers, absolute numbers. There are more people doing clerical roles. So they cannot become researchers. What do they do? My issue with whenever we talk about this subject is, and I'm not saying it's wrong, this response that AI is going to be an enhancement tool, you can just do other things better, other people will do that job. What will you do?
So AI helps you upscale. AI helps you scale your business.
Yes.
What will people do? I think there is a huge need for people to understand that there are. So, for example, your question, what happens to HR people who've been laid off? There's a lot of advisory work that can be done that you still need people to do that. There's a lot of consulting work that can be done. You still need people to do that. So those are roles which are still there and they will always be important. You can never let that go. The other question about clerical roles, I think there is a huge need to upskill. And when I say upskill to understand technology, upskill to understand AI, I think any role where you're adding value will continue to stay.
Okay, I don't know, Arsh, you want to come in on this? Because broad generic terms always sound great. What is going to happen on ground when you have so many people suddenly looking to upskill and then do what and go where?
So it's always the issue when it comes to India as the market with a lot of people looking out for jobs and there are no jobs. But at the same point of time, if I show you the industry perspectives, we don't have good engineers to hire. This is something that's coming from the industry, and I've been in this space from past 2-3 years, looking out at multiple top tech companies who come here, who establish GCCs, and they're looking out for tech talent. But it's still very hard to find good tech talent in India. So it is definitely upskilling that needs to happen. And this upskilling, not only in the tech skills that we generally say, if you want to become a software engineer, these are the 5 things that you need to learn. This is something that is going to be asked in your interviews. But at this point of time with OpenAI or companies like Google, Meta, shipping out updates every 2 weeks or every week, we need to understand that this is something that we need to embrace it along. We need to keep ourselves updated with whatever is happening in the industry. Whichever tools are coming into the market, we need to constantly see how we can use those tools in our workflows and make things easier for us. So the overall narrative, overall perspective is upskilling should definitely be there, and it is not just for people who are graduating from college, but anyone and everyone who is
fair.
in the industry.
All of these things need to be done. Now, I want to come back to the question: as a society, as a people, who is going to make this happen? The onus so far in all our conversations has been on the individual.
Yeah.
You upskill, you learn technology, you get better, you go from B to A. But is that a possibility for everyone to actually do? Dr. Ramanand wants to come in. Yes.
Tamanna, in my understanding, individual cannot, face this challenge alone. Government and industry should come together and to invest more in the parts of education and in upskilling work. Whatever we have done, it is very less, to understand the AI, the impact of AI. Undoubtedly, if we will not act together and immediately, it is going to impact, all parts of the society. And when I talk government, I should mention clearly, it is not up to only for the central government. इसमें स्टेट गवर्नमेंट का भी पूरा रोल रहेगा, क्योंकि स्टेट गवर्नमेंट के जो इंस्टीट्यूशंस हैं, जो लोग निकल रहे हैं जिस स्किल्स के साथ, उनकी क्वालिटी अच्छी नहीं है. और यूजुअली अक्सर हम दिल्ली में जब बैठे रहते हैं तो हमें लगता है कि सेंट्रल इंस्टीट्यूशन अच्छे होने चाहिए, सेंट्रल है, बट सेंट्रल का एजुकेशन में बहुत कम ही रोल है. ज्यादातर रोल स्टेट गवर्नमेंट्स का है. अगर आप एआई की डिबेट को, टेक्नोलॉजी की डिबेट को अगर आप स्टेट में जाकर के देखोगे और समझोगे, एंड यू विल फाइंड कि वी आर नॉट प्रिपेयर्ड एनफ. That's why I told in beginning.
I don't know what state governments can do. I mean, Ananya Batra, I want your take on this. How do you ensure, and obviously if you're running a company, it's not your business, it's not your owners beyond a point. You want to turn a profit, you want to grow your business. It's not your business to, ensure that enough people are hired. But how do you ensure that you have the right mix in place when you go ahead with AI adoption and with all the people that you're speaking to? The core question we're asking today, has that moment of inflection already arrived?
See, this scenario that you're talking about, right, it has happened before in history. So like I said before, in the 1940s, right, when the assembly line was being built, a lot of people who built the assembly line were fired, right? But that doesn't mean that shouldn't have happened and we shouldn't have built the assembly line. So see, I'm saying when you juxtapose this to the current situation that we're in right now, it is a very similar situation, right?
I'm so sorry, Ananya, but that's a tired argument. And I've actually been hearing it from the last several years. A, we're not in the 1940s. B, this is going to be a shift which is much more drastic than moving from one form of manufacturing to assembly line. This is going to change things in scales that we can't even imagine. That's the conversation I have with people in the field. And then at the end of it, the core message is too bad for those who lost those jobs to assembly line. Now, if they're in large enough numbers, can we then say too bad?
No, we're not saying that. We're not saying that at all. In fact, see, according to the World Economic Forum, right, about 11 million jobs will be lost, but 17 million jobs will be created, right? This is by 2030. So we're not saying that all these jobs will be permanently and these people will be jobless and homeless or whatever, right? We're not saying that at all. So this will be a temporary displacement. And see, the displacement is going to happen a lot quicker than it happened in 1914. So if it took like a decade or two to replace those people, replace those jobs, now it's going to take a lot lesser than that, right? It's going to take a fraction of that. So see, when we look at the bigger picture here, right, and when we look at the people who are sort of letting go of, it's all those repetitive tasks, right? So for example, even when we look at the coding jobs, it's all the boilerplate code that is being written by AI. And maybe some junior engineers would write that code, right, before pre-AI, right? It's those kind of people who are getting replaced, and it's everything that's repetitive that's getting sort of replaced, right? And that's being done by AI, and which I see on a longer time scale, right? That's a net positive. I see that as a good thing.
Okay, now here's the tricky bit. 11 million and 17 million, those two figures. How many of those 11 million are making it to the 17 million? 11 million who are losing jobs, how many of them are making to the 17 million which are new jobs? And if junior engineers are getting cut out right at the get-go, because it's starting with the lower rung, right? you don't have a chance to become mid-level or senior. Your career has effectively ended at junior. So that's the tricky bit, isn't it, Shruti? How do you go out and you skill yourself for a job? How do you prepare? I mean, the 20-year-olds or maybe the people in their late teens watching right now are going to wonder, so now how do I even prepare for this?
Manda, if you look at the 20-year-olds today, they are also of the mindset that it's okay to keep changing careers. We know people who had done tourism during pandemic and today they are doing, psychology and HR and IT. So I teach a lot of students who are in colleges and business schools, and the kind of mindset they have is very different. We know some roles are important, so we know renewable energy is important, we know research is important, we know electric vehicles are important. So I think that ability to move across jobs is there in the 20-somethings today, and we need to give them credit for it. They are not as hardwired to a particular career as we were when we were growing up. I think let's appreciate that one part of it. The other thing is, as far as upskilling is concerned, and I think Dr. Ramanand was talking about it a little while back, the government of India is doing a lot of work both at the center level and the state level to upskill. Telangana government is doing that. Maharashtra government is doing that. There are programs like Future Skills Prime, Yuva AI, India Mission. All of these programs are there to upskill people. And we are doing a lot of effort to ensure that there is opportunities for everybody. Now, as far as unemployment is concerned, it has been there year on year. If you look at April, the unemployment rate in that month of April in India was 5.1%. What are we doing about it? We are trying to ensure that jobs are being created and the onus of that is being put back on organized corporates. And both governments and we as an individually, I think each one of us, I run my own organization, and each one of us is taking the onus of ensuring there are opportunities there. And we need to take onus of that. We cannot give it all out to, as you were saying, it cannot be an individual's job to go and look for a job. We all need to create an ecosystem that supports everybody, whether it's in terms of upskilling, it's in terms of opportunities, it's in terms of the agility of saying that, okay, you were doing tourism yesterday, today you want to do renewable energy, fair enough, as long as you have the skill sets, you're giving quality, I am open to at least experiment.
Yeah, so that's from the employer point of view. Arsh, you're a software engineer and tech content creator. Today, if you wanted to be a full-time software engineer, would you be able to do it? How would you upskill? Give us your own perspective.
So when it comes to upskilling at this point of time, I totally agree with all the panelists. It should not be just the onus of an individual, but at the same time, government is doing a lot of things when it comes to India AI mission. Even the Googles and the Microsofts of the world have been taking a lot of initiatives, putting in a lot of courses for people to upskill for anyone and everyone. You mentioned about the HRs getting laid off, right? So if at all that HR is getting laid off, there is a course that they can start from the beginning and they can complete it in some point of time that will make them job ready in this AI market. So all of these big tech companies along with the government is trying to put in efforts. And if we just compare this situation right now of a 17-year-old or a 20-year-old here in India with a 17-year-old or 20-year-old in the US, so the difference that you see is people there are trying to build on their own. So they're building those AI products, they're selling those AI products and making those companies. So if at all that transition comes to India, we would have more jobs, more people looking out for AI jobs, as well as more people building those AI startups themselves. Coming on to getting a job in this market, fundamentals are very important when it comes to software engineering. You should be your core fundamentals are very important whether AI comes in or whether AI doesn't come in. So core fundamentals that are still taught in colleges, you should be well versed with those. Apart from that, it is the constant upskilling and upgrading yourself within this market that will put you in the pedestal and you will be in the top.
How do you start that process of upskilling and upgrading? What is the ABC of it?
So when you say upskilling and upgrading, once you are done with your fundamentals, right? When it comes to somebody getting a job in software engineering, you need to know a programming language. Then you need to upskill. You need to learn one framework. Then you need to build some projects and showcase it in a package form that is called your portfolio. So that's a basic set of credentials that you need to get a software engineering job. But now, as of now, with AI coming into picture, if at all you have some projects in which you can implement those AI applications or you can build some AI product, and it's not that hard, right? If somebody is already a software engineer. He knows how to read, how to understand code. He can build his own website, or he can build whatever he wants through different tools that are available in the market. Ananya was mentioning about Windsurf, about Cursor. So these are very, very helpful tools. And if somebody is already a software engineer, it would be easier for him to understand and build upon these tools. And it is very easy at this point of time to learn. There are so many resources. If you want to learn, you can go to YouTube. That's available for you for free. If you want to learn in a structured manner, there's so many courses out there that are available for very cheap, even for Microsoft, Google, Amazon, Nvidia. So they have launched their own courses.
Sure, go out and start. Just as we wrap up, Ananya, where do you think this is going? And yes, I get the point that Shruti is making, that not all job losses are about AI. There's global recession. Every company may have its own reasons. You can't get into the detail of it. But there's no denying that AI is one big factor. How far do you see this going? Are we just at the beginning of seeing this huge sea change of employment, efficiency, and tools that companies use?
I do think that we are at the beginning. Some say that, this is sort of similar to the internet era, right? This is sort of similar to the early 2000s when the dot-com bubble was happening. So I do think that we are very early in the entire AI cycle. As far as, your argument goes as, okay, what happens to 17, 19, 20-year-olds, right? I also know 17-year-old millionaires who didn't know how to code last year, but they learned everything by themselves. A lot of the code was written by AI, and they built their own AI products. Now they're hiring people, right? So we are seeing people like that as well. So everything that we talked about today, right? I think it can be solved by agency. Everything that we sort of talked about, all the job losses, right? All of those questions are answered by agency, right? So all of these things are a function of agency, is how I see things. And see, as far as the areas where AI is having the most impact, of course, coding is one of the biggest markets, right? Not the biggest, but in the medical field, right? And for lawyers, AI for lawyers is also growing very big. There are so many other fields, right? AI in agriculture. See, the possibilities are limitless. So, I mean, someone with very low resources could also build, something very big of themselves, right? They could become a millionaire. I'm not saying this is going to happen overnight, but you can, of course, do this.
Stop fearing it. I think that's great advice. Stop fearing it. Look at it as another opportunity, another tool. Maybe that mindset change is the first place to start. And then, of course, a quick AI-aided search will find you the right tools for your sector and industry to help you upskill. But this has been an interesting conversation. This is a story we'll keep tracking very closely. Thank you so much to all of you for joining us on the show today, and to our viewers as well. Thank you for joining us on The Big Question. We'll be back tomorrow, same time, same place.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know
Thanks for staying with NDTV. You're watching the Tuesday edition of the World Report. I'm Arjun Samar Mahendran. Let's take a look at what's making headlines around the globe. US President Donald Trump and Russian leader Vladimir Putin failed to reach a breakthrough on a Ukraine ceasefire during a 2-hour phone call Monday. Now, Trump struck an optimistic note, saying Kiev and Moscow will immediately begin negotiations, while Putin's more guarded comments signaled he hadn't softened his maximalistic demand so far. Here's what both the leaders had to say.
Did you ask President Putin to meet with you?
About what?
About Ukraine.
Of course I did. I talked to him about it. I said, when are we going to end this, Vladimir? I've known him for a long time now. I said, when are we going to end this bloodshed, this bloodbath? It's a bloodbath. And I do believe he wants to end it. You know, when I made the call, I told the people last night, I spoke to the heads of the different countries. But I said to them, we got to get going. And I did say also, if I thought that you couldn't do it, I'd step away, because what are you going to do? We don't have boots on the ground. We wouldn't have boots on the ground. But we do have a big stake.
States set forth his position regarding the cessation of hostilities, and the truth on my behalf that Russia also wants a peaceful resolution of the Ukraine crisis.
Meanwhile, my colleague Nina gets you this ground report straight from Washington, D.C. Take a look.
Well, US President Trump sounding extremely optimistic on the back of his phone call with Russian President Vladimir Putin. I don't think that President Trump can afford at this point in time not to sound like there's some forward momentum. He said last week that nothing would happen until he and President Putin had spoken. So in the very narrow scheme of things, that's a mini triumph. It's a mini victory. But it's also possible that President Trump believes that by injecting the right tone, it gives the lack of progress a kind of a shiny wrapper on a rather disappointing parcel. Since there has been no movement, we know that there's been no progress, there is no ceasefire, nothing's really changed, except that President Putin and President Trump have spoken. President Trump referenced on the back of that phone call with President Putin a possible trade angle, and we know that trade and investment deals are very much President Trump's thing, which, given the fact that he is capable of injecting a degree of chaos into trading relationships with partners, it does seem counterintuitive. But given his track record of cutting deals, especially if you look at his latest trip to the Middle East and the deals that he's been cutting with Gulf states, it's certainly a language he speaks, the language of trade and investment, and a number of foreign governments are lining up to offer President Trump deals in the hope of better preferential treatment.
Union Commerce and Industry Minister Piyush Goyal held productive discussions with US Commerce Secretary Howard Lutnick, focusing on expediting the first tranche of the India-US bilateral trade agreement. Now, Mr. Goyal shared an image of the two leaders shaking hands, stating good discussions with Secretary Howard Lutnick towards expediting the first tranche of India-US bilateral trade agreement. Israeli Prime Minister Benjamin Netanyahu allowed minimal aid to enter Gaza Monday, saying that he had to prevent mass starvation for practical and diplomatic reasons. Now, Netanyahu said Israel will take full control of Gaza, the besieged enclave, while acknowledging that the move to let aid through was motivated by mounting international pressure from allies. The UK, France and Canada in fact threatened sanctions and also demanded Israel stop its military actions, while US President Donald Trump's administration has also launched a behind-the-scenes pressure campaign, as per the Washington Post's latest update. The leaders of Canada, Britain and France on Monday threatened actions against Israel if it does not stop a renewed military offensive in Gaza and lift aid restrictions as well. Now, this piles further pressure on PM Benjamin Netanyahu. The Israeli military, meanwhile, announced the start of a new operation on Friday, and Mr. Netanyahu said earlier on Monday that the country would take control of the whole of